10 great offers, I think was what he said in the last 24
10 great
hours.
offers.
So
let's hear them.
watch this space. Watch this space. Watch this space too. Mark Zuckerberg taking a stand in the FTC's Meta antitrust case, testifying about the company's 2012 purchase of Instagram. Federal prosecutors looking to prove Meta brought its way to a social networking monopoly. Lisa, that stopped this morning, up by 2/10.
Mark Zuckerberg is going to say at the time, we were very concerned that we were paying too much. We had no idea. This was very difficult, and that Meta was faced with a sea change in competitive conditions. On the flip side, the argument is going to be, look at what happened when there was the potential banning of TikTok. Look who got the benefit. It was really Instagram. It was Facebook. It was Meta. So it shows how singular they are in their market position.
There was a time when the president was deeply unhappy about that prospect as well. And now they've kind of made up, right?
Well, now Mark Zuckerberg says that he's badass and it's wonderful and he's wearing a necklace and things have changed.
There's a big change in the last 12 months. Let's talk about tech a little bit more. Apple, looking to recover recent losses from tariff uncertainty. The Trump administration moving forward with trade pros for semiconductors. Gil Luria of D.A. Davidson writing, Apple is more in a bind than other mega caps because it has not only to deal with the exposure to tariffs, but also to a slowing U.S. consumer. Gil joins us now for more. Gil, welcome to the program. Let's talk about these exemptions first. If these companies are focused on securing exemptions, who's focused on building factories domestically here in the United States?
Well, they all have to. They all have to align themselves with this administration. The administration's made it clear that it takes action if you don't. So for the companies that are in the business of hardware, of the mega caps, we're talking about Apple and NVIDIA, they've had to make some pretty lofty statements about bringing production back to the U.S., and they're going to have to start acting on those. But they're also going to have to start taking more and more production out of China, because the theme of decoupling seems to be almost beyond the theme of tariffs.
Well, Gil, as you know, Apple started that process. They started to shift production to places like India. Can production in India meet U.S. demand?
Not in the short term. Right now, they're scrambling to make phones in India. They tried to fly those out before the tariffs come in to save a little bit here and there. But they can't make all the iPhones outside of China right now. They can start ramping up that production over the next several years. But for the foreseeable future, they have to make phones in China. And ultimately, the phones in China will only be for domestic production. But that's a multi-year process to get from where we are now to where they're producing in countries that have zero tariffs or lower tariffs.
The shares are down almost 20% so far this year, and yet still pretty high valuations, still pricing in quite a bit of growth. Gil, do you think that investors are still too sanguine about the fact that the upgrade cycle and the next phase of the consumer spending cycle isn't going to look quite how they thought it was maybe 2 months ago?
Yeah, investors' expectations on those fronts have been reduced very substantially. I think there's very little contribution from AI embedded in expectations now. There's very little expectation that consumer will be strong. I think there's an understanding that this year is going to be a tough year for Apple because the consumer was already weakening before the tariffs. Then we layer Doge, we layer less immigration, we layer the concerns from tariff. So investors understand all that, but what they also know is that Apple is a product that we're going to continue to consume more and more of. Am I going to buy a new phone in the next 3 to 5 years? Am I going to pay more for it? Am I going to use more of Apple's services? If all those things are true, people see Apple as a defensive investment, like Costco, like Walmart, not like a technology company, and that's why the multiple is persistently high.
Gil, let's talk about another technology company. This time it's NVIDIA. Just getting this post from the President of the United States out on social media. NVIDIA committing $500 billion to build AI supercomputers, plus in the United States exclusively. This is very big and exciting news. All necessary permits will be expedited and quickly delivered to NVIDIA, as they will to all companies committing to be part of the golden age of America. Gil, do we have the talent, the skills, the workers in America to make these kind of shifts and fast?
Not today, we don't, but we need that talent. This is very important. We need to bring those skills back to the U.S. Right now, they're almost entirely in Taiwan and China, and we have to learn how to make this technology because it's critical for our infrastructure, it's critical for our national security, and that's what NVIDIA and TSMC are now doing. They're moving production to the U.S. There already is some production in North America, but they're moving more of it now into the U.S. because there's been a decision that this is a matter of national security. Now, this isn't something NVIDIA would have chosen to do otherwise, but they have to make a jump in its administration because we're now in an investigation of semi-tariffs and policy where this administration is going to make important decisions about limiting sales to China. And if NVIDIA is selling somewhere between 20 and 40% of its equipment into Chinese companies and into China, it really cares about where those restrictions are going. So this is the time it needed to make a gesture towards President Trump in order to try to skirt the further restrictions in terms of the relationship with China.
On January 21st, Gil, we were talking about how this president seemed to really celebrate the national champions of the United States. People were saying that this was a pro-business president who wanted to see the giants that really represented this country, in particular tech, to really succeed. Then there were some real questions about that. Would the policies that he put in place with respect to tariffs undermine them completely, Apple leading the way? How much support are we getting a sense that this president will give to U.S. national champions as this process of some sort of transition is underway?
They're a party in the negotiation. This is why they need to make these gestures. They shouldn't take anything for granted here. They are negotiating with this administration just like all these other countries are negotiating with the administration. The administration has an agenda. That's what they're trying to pursue. If Apple, NVIDIA, and the other mega caps cooperate with the administration, they'll get the positive outcome, and if they don't, they won't. Let's not forget there's a long-term memory. We're talking today about the Meta trial. The Meta trial isn't about a monopoly. Meta isn't a monopoly. The Meta trial is about, it was about Cambridge Analytica. It was about deplatforming President Trump. There's a consistent, persistent notion across administrations that big tech is out of control and that needs to be reined in. And that's how they need to think about this, is how do they work with the administration without making the administration feel like they're out of control.
Hey, Gil, appreciate your input and your opinion. Thank you, sir. Gil Laurie there of D.A. Davidson. Equity futures at the moment just about unchanged. Let's get you an update on news elsewhere. Lots going on. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A New Mexico man was charged in connection with arson attacks on a Tesla dealership in the state's Republican Party headquarters. 40-year-old Jamison Wagner faces 2 federal charges related to separate fires that involved homemade incendiary devices. Prosecutors described it as domestic terrorism. Wagner faces up to 20 years for each count if convicted. Apple will start analyzing customer data to improve its AI platform. It typically uses synthetic data to train its models, but that information isn't always representative of consumer data. The plan is meant to help the company's AI catch up with competitors like OpenAI and Alphabet. Rory McIlroy's nail-biting victory at the Masters tournament was a rating success. Viewership was 33% higher than last year, making it the most-watched Masters since 2018. The tournament's final round drew an average of over 12 million viewers, according to CBS. That's up significantly from the first 2 rounds on ESPN that averaged under 4 million. And that's your brief, John.
Hey, Danny, thank you. Just fantastic for the game, that's for sure. Danny Berger there. More from Danny later on in the next hour. Up next on the program, defending the bond market.
I don't think there's a dumping, and I think we saw in the tick data either today or Friday that actually foreign ownerships picked up.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence that it's sovereign.
Just a brilliant exchange between the Treasury Secretary and Anne-Marie yesterday. We'll have reaction from Priya Misra of JP Morgan Asset Management in just a moment. From New York City, you're watching Bloomberg TV.
case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Equity futures turning slightly lower. We're down 0.2%, coming off the back of a two-day winning streak on the S&P 500. Down a 0.1% on the Nasdaq 100. If you turn to Bank of America in the pre-market, so far so good for the financials on Wall Street. That stock is up by 1.6%. Upside surprise on trading revenue. Upside surprise on net interest income. Wrapping up earnings on Wall Street in just a moment. We'll hear from Citigroup in about 12 minutes from now. Under surveillance this morning, defending the bond market.
Even the president recently remarked that the bond market was, quote, queasy. Do you have a sense of who is dumping U.S. assets? Who's been dumping U.S. treasuries?
I don't think there's a dumping, and I think we saw in the tick data either today or Friday that actually foreign ownerships picked up. I think a lot of people got very leveraged, maybe out over their skis.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence that it's sovereign.
So here's the latest this morning. The Treasury Secretary, Scott Bessent, downplaying the recent sell-off in the bond market while saying his department has the tools to address any dislocation if necessary. Priya Misra of JP Morgan Asset Management joins us now for more. Priya, good morning.
Morning.
You followed that exchange. What did you make of the explanation coming from the Treasury Secretary?
I think the Treasury Secretary is doing what a Treasury Secretary should do, be a cheerleader for the Treasury market. But, I do think he made very valid points that now, what we saw last week, the last few weeks, massive VAR shock. You're seeing 3 sigma, 6 sigma moves across assets. You're seeing correlations break down. Remember that equity dollar correlation, that broke down. And so I think investors had to de-lever, de-risk, were there margin calls. So I think there was a lot of technical factors that drove that Treasury sell-off. In the background, though, there is this concern. There's 8 trillion of treasuries held by the rest of the world. Is the end game zero trade deficits? I don't think that's the end game, but concern around foreign demand for treasuries, maybe selling, I think that played into that fear, certainly played into the market, as well as if we're going to get 5 trillion more deficits because of what the House and the Senate are talking about. I think that just became this perfect storm. But I would take a step back and look at fundamentals. Ultimately, the Treasury market is driven by fundamentals. Fundamentals of the hard data has been strong, but we've just had this massive shock to the economy. I think the soft data is telling you that the hard data is likely to weaken. So I do think Treasuries are a good buy. Are we at peak? Hard to say, but we're getting there.
Well, you're getting to the ultimate test. What would happen if the data weakened? Would we buy treasuries or not? Would the rest of the world allocate capital to the United States, which is important? What concerned people last week wasn't just a sell-off in treasuries. It was what was happening elsewhere in other asset classes. Now, we've seen moments like this one before, where you see forced selling of treasuries, big unwinds of trades, companies, hedge funds in trouble. That's not unique. What was interesting was the persistent dollar weakness alongside that, reinforcing the notion that maybe it was something else. Perhaps it's not, but that's what unnerved people in the past week. How would you reconcile what was going on there?
So I would say that the dollar, has been a highly owned asset, right, for the last few years. Now, I think there's structural components to that, U.S. exceptionalism. Look at where growth is. It is U.S. Companies, profit margins are high. And I think right after the election, there was this idea of re-acceleration. So the dollar got some more of a boost there. Plus, it was supposed to hedge equity risk. It was supposed to hedge risk assets, which is... So I think the dollar, the structural value in the dollar might still be there. Maybe we overdid it. In our view, the dollar still looks overvalued. So I think that's correcting. And then you had this treasury market that was overwhelmed, I think, with all of the selling. There were a lot of supposedly uncorrelated trades. Swap spreads is a supplementary leverage ratio trade. German Bund treasury or that spread was supposed to be about German fiscal stimulus. You had an unwind. Whether people got a tap on the shoulder, whether they're just trying to de-risk, whether it's margin calls, I think that overwhelmed. So you did have these two forces coming together, but it's unnerving when you see correlations break, when you see this EM market-like market moves. I think that's what reduced conviction levels, and we're seeing headlines every day. So I think uncertainty is high, not just for the economy, but for investors. And I think that's why you didn't see all this buying from domestic investors who might be concerned about the economy.
How much comfort do you get from the potential response function, not just from the Federal Reserve, but also the Treasury Department, with Treasury Secretary Scott Bessent saying that they could buy back off-the-run treasuries?
So I think from market functioning point of view, I think that buyback operation is useful. The Treasury launched it because the dealer balance sheet has been constrained as the treasury market's grown. Can they help market dysfunction? Yes. Can they help? They still have to issue a lot of debt. So I think we're going to be watching beyond all the tariff news. We're going to be watching what's happening on the tax front. Are we going to get those spending cuts that were sort of promised by Speaker Johnson? If you don't get those spending cuts, the market has to then grapple with a lot more deficit. And maybe that end point of how low rates can go in a recession or in a slowdown is going to be higher because we've got all this fiscal stimulus. I'm a little bit more comforted by the Fed response function. And I think Governor Waller yesterday was crystal clear. Two scenarios, as clear as he can be, given that there's a lot of uncertainty, but just telling us how are they thinking about tariffs. And he talked about good news cuts and bad news cuts, showing you that asymmetry.
Okay, but here's the issue, and this is something that I haven't heard anybody address. If they were to cut rates in response to potential weakness that hasn't shown up enough yet in the data, wouldn't the long end just yield surge, price drop?
And you could argue maybe some of that happened last year when the Fed cut rates from 5.5, you had that long end selling off. But I would say, look at what was happening to hard data at that point. It was actually looking okay. Remember, we were concerned. August, September, we were concerned about the labor market. It stabilized, and that's why the long end sold off. I think, to your point, yes, the Fed has to be concerned. Will they let inflation expectations, those tips break-evens that have been declining, does that reverse? Which is why they can't be preemptive. I think that's what they're telling us. They're trying to explain their reaction function so that first really bad hard data, and maybe it's the labor market, I don't know, maybe it's hiring, maybe it's retail sales. We're going to be looking, not so much as there's this front loading of demand, we're going to be looking at discretionary spending. If I am going out to buy more because I think prices are going to go up, do I cut back on other things? So we're trying to understand how the consumer is responding, how are corporates responding? Are they just not hiring? Or are they actually trying to protect margins and laying off? As that data worsens, I think then the Fed response doesn't unanchor inflation expectations. It actually helps stabilize it because those inflation expectations will crater when the data weakens. And then the Fed can say, no, we got your back. But I think you have to first see it in the data.
This is the communication dilemma of the Federal Reserve. Fed Chair Jay Powell can't go around talking like Governor Waller can. First and foremost, you have to pledge to anchor inflation expectations, to Priya's point. Then if you get the hit to growth and inflation expectations roll over, you can lean into the idea you're going to cut interest rates. They can shape the events they anticipate. And that's the big issue for them. You put out an outlook, and it can influence inflation expectations even of themselves. To your point, if Chairman Powell comes out and starts speaking like Governor Waller, what do you think is going to happen? Yeah. Some people would argue exactly what you think is going to happen. Maybe inflation expectations start to creep higher because we start to have arguments around this table. Oh, they don't care about inflation expectations. That's the dilemma they're in.
And this is the reason why markets don't believe that they won't step in when there is a problem in the data. And that's the reason why you have the likes of Andrew Hollenhorst over at Citigroup reaffirming his belief in 125 basis points of rate cuts this year.
I'll leave Priya out of this debate because you won't want to wade in, but this is the advantage you have being a governor and not the Fed chair. The governor can create some distance between himself and the rest of the committee if, say, he wanted to become the next Fed chair.
Potentially.
In the next year or so.
So, do we trust that, or do we trust Fed Chair Powell? This is the dilemma.
Priya, it's good to see you. I'm sure you're welcome being left out of that. Priya Misra, JP Morgan, thank you. Up next, Chris Marinak of Janney Montgomery Scott. We'll catch up with Brent Schutte of Northwestern Mutual, and we'll speak to the Virginia Governor, Glenn Youngkin. All of that in the third hour of Bloomberg Surveillance. Up next.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that. It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah. We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
I
I did not like all the mixed messaging we got on tariffs over the weekend.
We are getting some certainty. I just think markets haven't been liking the certainty that we're getting.
The more that Donald Trump seems to double down, the more investors think this is an unsustainable path forward.
It's not a sustainable situation.
If we continue along this current path of uncertainty, where objectives are not stated, it's going to continue to maintain, I think, an unhealthy level of volatility for the markets.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Wrapping up earnings on Wall Street, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures slightly softer, down by 1/3% on the S&P, following a two-day winning streak. On the Nasdaq 100, down by 0.2%. If you turn to Bank of America, those numbers came out about an hour ago. Upside surprise on trading, on net interest income. That name is up by 1.8%. The takeaway from the bank, this consumer is in good shape, and this economy, for the first quarter at least, is doing okay. Similarly from Citi just moments ago, Lisa, those numbers crossing. Nothing to see here. Everything seems to be okay.
And it seems like the big question that we had two big questions. How much were they going to be preparing for some sort of downturn in consumer appetite? And how much was the wave of mergers and acquisitions deferred versus delayed? It seems like those are delayed, to start with that first, rather than deferred. And it seems like the consumer isn't weakening. The rhetoric from the Bank of America call is that, frankly, the consumer in the U.S. is in good shape. The investment banking pipeline is stronger than last quarter, and this from the CFO. Clients continue to show encouraging signs. This is a cycle that right now at least seems to be delayed, but not completely derailed.
So Bank of America doing absolutely fine. Goldman Sachs with a buyback of up to $40 billion. JP Morgan raising their outlook. Citi just crossed, Lisa. Full year 2025 guidance unchanged.
And the fact is, they actually saw better than expected banking business. And frankly, you're looking at all across the board beats and seeing that continuing. They also did beat on fixed income sales and trading. So the trading side of things even was good for them on the debt trading issue. Look, this comes to this question of how much is this a signal for the rest of corporate America versus a ballast in a storm with a lot of different pistons that are firing at different speeds. Right now, I'm not seeing weakness on any of those pistons.
Citi up in a pre-market by 0.6%. To break down the numbers, let's bring in Shonali Bassett for more. Morning, Shonali.
Good morning, John. Listen, if the banks can do it, so can you. You have Citigroup keeping its targets for the full year. You had Bank of America do the same. The big question coming into this earnings season was, how do these companies set guidance? And so many other parts of corporate America looking to either scrap, cut, or not give a lot of clarity on theirs. For Citigroup, another promising sign, a key measure of their profitability, of course, their return on tangible common equity rose to 9.1%. This is significant for Jane Fraser, that is looking to get to 10 to 11% into 2026. This is a bank still in the middle of a big turnaround story. To Lisa's point earlier, very healthy on those core Wall Street businesses. Remember, Jane Fraser has been hiring, has been changing the composition of the top ranks in all of those businesses, and that's why that matters just so much. When it comes to net interest income, you're also looking at a little bit of a beat there, and you're also looking at credit quality remain quite healthy. So banks staying sanguine in the middle of all of this uncertainty.
Shonali, appreciate it. A release full of upside surprises, and I would say a more pointed address, more pointed commentary coming from Jane Fraser than maybe the rest of the street. Lisa, on some very important issues.
Yeah, she came out and she said, when all is said and done, the U.S. is still going to be the leading economy, and the U.S. dollar will still remain the reserve currency. So weighing in on some big topical issues of the day.
The Citigroup in a pre-market up by about 0.5%. Joining us now to extend the conversation, Chris Marinock of Janney Montgomery Scott. Chris, welcome back to the program, sir. Wall Street, that wraps it up. Earnings season. What's the big takeaway for you and the team?
Well, I think that the companies are very resilient, John. I think that the cost of funds has come down. Credit quality is stable, as you have all mentioned. We saw a slight reserve build at Citi, which has been true at the other banks so far. I think it is the calm before the storm, because we still have some uncertainty in the second and third quarter about how corporate America is going to act on recent events. Perhaps it is a non-event. We don't know yet. I'm looking for credit lines to be partially drawn and some of the C&I loan growth to get better in the second quarter, kind of like we saw in the first part of COVID in 2020. But this is not the same, obviously. These companies are in a very good position here with the credit quality and the loss expectations still being very muted. And I think we're a long way to go before we really call this a big credit event in terms of what's transpired in April.
Chris, is it encouraging or a bit cautionary that you're seeing a number of these banks not build credit loan loss provisions as much as some people had expected?
I think it is what we expected. I think the timing of when you rebuild reserves is going to be second and third quarter. If we see this inflection in the economy, if we do see a demand shock as folks are worried about, if we do see lines of credit get drawn, we haven't really seen that yet. I think it might be starting to happen in the Fed data every Friday, but it's so early that it's hard to detect. I think at the end of the day, a lot is going to change day to day and week to week, that we may have a much more calmer attitude towards this fear here in a few more weeks.
The other question that we had was, is this mergers and acquisitions wave derailed, or is it just delayed? It seems like a lot of the banks that have come out say that it's just delayed. You've heard that from Morgan Stanley. You heard that from Bank of America. The pipeline is building. What do you think will catalyze those deals at a time where there still is quite a bit of uncertainty, Chris?
Well, Lisa, for the banks, I think regulatory reform is still here. I think we're still going to see rule changes and new staff members at the FDIC, the OCC, and even the Fed in terms of supervision. That's going to be a catalyst. I think the attitudes will change. Consolidation in these industries, whether it's banking or other sectors, is going to continue to happen. So I don't think we lose that. It's simply a delay. It's a pause. As stocks get stronger and we see some sort of stabilization of all of the noise and kerfluffle, that I think is going to back into more activity in the second and third quarter. So I haven't given up hope on that. I think the regulatory reform is the biggest component that we didn't see in prior years.
Hey, Chris, appreciate you jumping on. I know it's a busy morning for you. Chris Marinac there of Jenny Montgomery Scott, the latest on Citi. Lisa, we have heard that repeatedly in the last few days. Delayed, not derailed.
Right now, you're seeing a pipeline that is stronger than last quarter. This, according to the CFO of Bank of America. Over at Citigroup, they actually beat on their banking revenue, even at a time where deals were slow. So it raises the question, what are companies waiting for to take action, to pull the trigger, given the fact that the dust hasn't cleared entirely, but maybe we're past peak uncertainty?
Joining us now is Brent Schutte of Northwestern Mutual. Brent, welcome to the program. Let's use that phrase that Chris Marinac just used, the calm before the storm. Looking at the earnings on Wall Street, calm. What about the storm, Brent? How big's that storm going to be?
I think that's an open question, but I think the delayed commentary ties more to this being, at least in many investors' minds, a negotiation. I believe it's something a little bit more than that. I believe it's revenue and restructuring. So on the trade side, I don't expect that to go away. And that's where I think you have uncertainty that's going to hang over the markets and the economy for the next 30, 60, 90 days, maybe even longer, as we go back and forth in the trade and tariff narrative. And that's where I think negotiations are going to be more difficult. And that's where I think perhaps Wall Street still has some surprises ahead, which may be more to the downside, not upside.
Speaking of Citigroup, the research team, just going to The Economist, Andrew Honhorst saying the tariff pause may not pause the economic slowdown. But I think this is important. People are pointing out that we were slowing down coming into 2025. What people were hopeful for was a pro-risk, pro-growth approach from the incoming administration to help growth accelerate through the year ahead. Brent, now people have got doubts, and clearly those doubts are captured by the soft data. And what we keep going back to repeatedly is whether that will be captured by the hard data in the weeks to come. What's your base case now?
I think it will be captured by the hard data. I think the fall in the market obviously brings back the wealth effect just a bit. And so you mentioned overall economic growth last year. Yes, it was positive, but it was heavily bifurcated. You think about manufacturing, you think about small cap companies not doing as well and small cap earnings being pulled back. You think about low end to middle end consumers being harmed already by interest rates that had risen to 21, 22% on credit card debt, auto loan debt. And that's where I think there was much bifurcation underneath the surface. And I think the question is, as you mentioned, can the high-end consumer continue to hold it up? I think the fall in the market will pull back some of that spending. I also think about a labor market, which overall was still looking strong, but there was bifurcation there. And I think Chair Powell characterized it as low hiring but low firing. Do companies continue to hold on to employees with the hope that things will be better in the future? I think that's the question going forward. And at least in the near term, I think the risks are still elevated, even though, quote unquote, uncertainty has come back. I still think there's plenty of uncertainty to go around for the next 90 days.
Brent, based on what you just said and the caution that you feel, are you selling rallies in equities? Certainly, we might get a third day of rally today. both in the S&P and the NASDAQ, going back to April 2nd, and go into bonds, or is the playbook changing?
I don't think the playbook has changed. Look, I think longer term bonds in the U.S. would be a little bit more challenged just because I do think inflation is still the likely outcome given our deficit to GDP and the reality that I don't think sometimes we want to take our medicine. And that's where I think inflation is more likely an outcome. I understand the fears around the Treasury market. I do think that the dollar is going to pull back. It'll still be the global reserve currency, but might it not fall just a bit to help with some of the trade deficits that the administration sees as a problem? I think in the near term, if you were to move towards a recessionary environment, I think the dollar would start, the Treasury market would still find a balance, and I think investors would still run there. I just think over longer periods of time, you are seeing more of a trend change, perhaps just a little bit away from the dollar and more towards other currencies and other asset classes.
Brett, there's another risk as well, which is that we're underestimating the strength of the U.S. economy. We're underestimating the other pillars of this administration's policies of deregulation, as well as some of the tax cuts to come, and that actually the U.S. consumer is fairly strong, and that we could bounce back from this bout of uncertainty with the same kind of momentum that we saw earlier this year. How do you sort of justify caution at a time where you're certainly seeing the deterioration in the soft data, but you're hearing rhetoric from companies portraying a very different reality?
Yeah, I mean, there's so many different ways to answer this question. I think the market still reflects the reality that no one believes that it's going to be anything more than just what you mentioned. I mean, trading at 20.5 times forward 12-month earnings expected to grow 10% in the S&P 500, I think already discounts some of that reality. I think if your narrative proves to be true, which we think about being more long-term investors, I think that's where you still, despite sounding like a broken record, you still want to own small and mid-cap companies trading at 13 to 14 times forward earnings that haven't grown that much in the past couple of years. In fact, for small caps, they've actually faltered. That's where I think it's not a necessarily sell everything type of an environment by any means. We stick to our long-term allocation, but maybe just nudge more towards those and even think about international securities, which I think will have a falling dollar as a tailwind for U.S.-based investors. And so I think the narrative going forward changes. People are still stuck in this last 5, 6, 7 years where U.S. large cap stocks have done well. I think you are now seeing the trend shifting, and I think there is an economic backdrop that supports that pushing forward, given what the U.S. is trying to accomplish with defense and trade.
Brent, this is such a strange moment. You brought up the reserve currency. How unusual is it to hear the CEO from a major financial institution feel the need to say that the dollar will remain the reserve currency?
It's a bit odd, but I think we've been here before. I mean, I always go back to the late 1990s, and having done this for almost 31 years now, I certainly remember the dollar being expensive back then. I remember U.S. exceptionalism. I remember U.S. assets trading at a premium. And then I remember the next 6 or 7 years, the dollar falling on the dollar index, I believe, from 120 down into the 70s. And it remained the reserve currency. This is just where I think there's a little bit of a restructuring going forward. And I think if the administration wants more trade, wants the U.S. to be more competitive, I think the dollar has to fall for that to occur. And that's where I think there's just a bit of a difference coming or going forward, where you might see other asset classes do better as a result of that.
Well, Brent, other asset classes in other places, is that what you're anticipating?
I do. I think there's a different narrative that the international markets are waking up to, where they have to spend. You think about Europe and what happened in Europe. I think that's where there's a potential for those asset classes, which have been cheap. I think this is their moment where that cheapness may be met by a new reality, a catalyst that actually propels them forward. And they've done very well at the beginning of this year. And I expect them to continue to do fairly well in the coming years as the new narrative plays out.
Hey, Brent, appreciate the update. Brent Schutte there of Northwestern Mutual on the situation in financial markets. Let's start with that before we get to the banks. It's very different to say that there's been this very long dollar trade building up over the last 10 years because of exceptional U.S. companies. That's one thing. To say that we're moving away from dollar-denominated assets like treasuries because you're doubting the policy stability of the U.S. administration and the safe haven status of America, I think they're two very different stories.
This is the reason why markets tend to overshoot, because they take a narrative and then they push it to its illogical extreme, which is the loss of the U.S. dollar as a haven currency and treasuries that aren't going to get a bid from foreign investors. And then investors have to decide what is the right story. There is a very logical story that Brent just told there, that if the United States wants to increase its domestic industrial production and its exports and actually close that trade deficit, the dollar has to be weaker, period, full stop. And actually, one thing that Scott Besson, in his prior job as Key Square Capital Management CEO, talked about this, that actually the dollar needed to be weaker to bring production back here, and then it could strengthen with a strong dollar policy.
Anne-Marie asked him a fantastic conversation, a fantastic question yesterday. When he was with us around the table, he talked about putting his ear to the door to listen to what policymakers were doing to understand how it might influence financial markets. And Anne-Marie asked him, what would your advice to be to other people who have to do that now, listening to you? And he said, focus on the fuller policy platform. That was basically the message. Don't focus just on trade, focus on all the other things as well. That's a really difficult thing to do at the moment because the volatility around policy, trade policy, is so high that it's difficult to imagine what's going to come next and where policy will be 12 months out.
The three-legged stool of policy with respect to tariffs, with respect to tax cuts, and with respect to deregulation. The other reason why it's difficult to game out is because it's unclear what they're going to coalesce around in terms of both tax cuts as well as deregulation in Washington, D.C. It is a murky picture.
Futures right now, just a little bit negative. We're down by 0.2%. It's been a very murky, difficult week or so. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Citi continuing the big trading quarter for the big banks this earnings season, up just under 1% in the pre-market trade. Citi reporting a beat on sales and trading revenue at $4.48 billion versus the $4.37 billion estimate. Loan loss provisions, though, did come in higher than estimated, but altogether, the results pushed Citi closer to its profitability targets. The Trump administration announced that it launched probes into semiconductor and pharma imports earlier this month, a move which could lead to new tariffs on the sectors. The probe, led by the Commerce Department, is investigating the impact of the imports on U.S. national security. President Donald Trump pledging to expedite permits for NVIDIA following the company's commitment to producing AI infrastructure in the U.S. In a post on Truth Social, Trump also promised expedited permitting for, quote, all companies committing to be part of the golden age of America. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the program, the Morning Calls plus Tom Fitzgerald of TD Cowen with United Airlines reporting later on this afternoon. Live from New York City with futures slightly softer. We're down about 1/3%. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
2 days of gains on the S&P 500, running into just a little bit of weakness this morning. We're down by 0.3% on the S&P, down 2 on the Nasdaq 100. That's the price action. Let's get you some morning calls. First up, Barclays downgrading General Motors to equal weight, expecting auto tariffs to continue to weigh on the stock. That name is down by 1% this morning. Your second call from Bank of America, double downgrading Dow to underperform, citing a perfect storm of softening macro, emerging trade barriers, and rising costs. That name is down by almost 4%. And finally, Redburn Atlantic naming Nvidia as a top pick, expecting resilience amid tariff uncertainty. That stock is just about unchanged in the pre-market. Let's turn to the airlines. United Airlines reporting after the closing bell. Tom Fitzgerald of TD Cowen writing, "We expect a world of slower growth, higher inflation, and a more isolationist United States to significantly disrupt the competitive environment for airlines. But United remains our best idea for 2025. Tom joins us now for more. Tom, welcome to the program. We'll get to the best idea in just a moment. What would you expect in terms of guidance from the airlines, given what they've already told us over the past few weeks?
Thanks, Jonathan. Yeah, in United's case, I think it's going to be a little bit similar to Delta, where, maybe the second quarter has a possibility of being a little stronger than people expect, and we have strong international bookings out into the third quarter. I think the rest of the sector, it's going to be a lot more difficult. They're more exposed to price-sensitive leisure. They're also more exposed to customers who are booking much later on in the curve, more closer in, which makes it a lot more challenging to navigate in an environment like this.
Tom, can we stay on international? Because we've all seen the same reports of inbound travel into the United States being absolutely dreadful. Bookings from places like Canada, from Europe, just not being great. What's happening on that front?
It's been a major headwind, and non-U.S. travel into the United States had already been depressed versus its 2019 levels. So this is just another headwind on that source of demand. For the U.S. airlines, Delta talked about last week how non-U.S. is only about 20% of their international point of sale mix. So it's less of an issue for them than it is for the European airlines or Air Canada on their transporter market. But it's just another drag on top of weak government travel, weak travel in corporates like autos and agriculture, aerospace and defense, weak domestic economy cabin demand.
How much are United and Delta and American Airlines going to try to really capitalize on this moment and gain market share in a pretty significant way from the others, given the fact that they have other streams of revenue, credit cards, as well as significant loyalty programs, as well as catering to wealthier individuals that do typically spend more and offer them more profits?
Exactly, and I think that's what we think is going to happen, and they're going to use basic economy as a loss leader and use that really effectively to maintain share and put more pressure on the low-cost carriers who have already had a tough go of it post-COVID.
So that's the reason why maybe they stand out as being the brighter in the bunch in terms of airlines. I'm curious how much visibility you think they have going forward, whether they're going to offer a relatively sanguine look or whether they'll already have a sense of a deterioration in consumer demand that we see reflected in some of these surveys that are pretty dismal.
I think they're seeing it, and they're probably one of the first industries that's seen the pullback and seen this effect on uncertainty in the economy. Typically their crystal balls only go out 2 to 3 months where they can have real good conviction, and a lot of the rest of it is just finger in the wind. And people book international travel, that tends to be, you might book that several months in advance, but flying to Florida or Vegas, those tend to be a lot more closer in. So it's really challenging. It's already a hard industry to operate in the best of times. You're juggling a lot of plates, and this environment just makes it that much more harder.
Tom, when we first heard from Delta and they came out with that warning, they offered a whole range of excuses for it. It wasn't trade at the time. Really, the focus was on things like Doge and what would happen to confidence around business spending, contractors, federal workers, etc. Then there were the aviation safety issues as well. Can you pin down what was really weighing on that outlook, what led to that stalling in activity in the first quarter?
The Doge stuff was definitely real, probably less of an impact for Delta than United and American, just considering that they both hub in the DC area. But government travel is, several points of revenue, and the government adjacent, your Booz Allens of the world, that's another couple points of revenue. So that's pretty material if that's down 50%. I think the accident and some of the weather stuff, that wasn't as big of a headwind on the, that wasn't leading to the profit warning that we saw in March from the group. So I would say it was the Doge tariffs on government travel, which is just a segment of the corporate travel really. And then you get all the uncertainty around tariffs and the broader economy.
Tom, it doesn't sound great. When you say United's your top pick, do you mean a top pick in a down market, or do you actually think that stock can perform this year?
I think over the longer term, I think it really has I think they have the most upside of the U.S. airlines, and their current management team has them on an incredibly compelling trajectory. I think in a down market, if we're going into a deep recession, any type of consumer cyclical like this it's going to be tough, and then it's more on a relative basis on the short term.
It's certainly been difficult, that's for sure. Tom, appreciate your time. Tom Fitzgerald there of TD Cowen. Thank you, sir. Thank you very much. United Airlines down about 0.5%. Lisa, as you know, those numbers drop after the closing bell.
There are two different arguments here, and you distilled them well, which is this can be the brightest bulb in another kind of dull sea of bulbs, or this can be a real outperformer. Unclear to see. One thing that has been a theme is that the strongest players are going to consolidate market share during this period of time because they have the biggest ability to renegotiate supply chains and potentially to compete in price or invest in price, as Walmart said, and potentially attract new customers as a result.
You heard what he said about Doge. Doge is real. It really started to weigh on activity for businesses, contractors, federal workers. We saw that. That's what we heard from Delta pretty much directly.
It wasn't just the number of people who are federal workers who got laid off. Evidently, for every one person who works for the federal government, there are two contractors who do get revenues as a result. You have to think that some of these surveys that show that people increasingly are worried about losing their jobs have to do with the fact that people know people who have lost their jobs as a result of some of these efforts.
We'll have this conversation in just a moment. Futures are a little bit softer. No drama here. We're down by 0.4% on the S&P. Up next on the program, the perfect guest to talk about some of these issues. We'll catch up with the Virginia Governor, Glenn Youngkin, as President Trump's tariffs hit at the state level. From New York, this is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Live from New York City, 60 minutes out from the opening bell. Equity futures at the moment negative here by 0.4% on the S&P. Coming into Tuesday, two-day winning streak on the S&P 500 for the first time since April 2nd. We're a little bit softer on the Nasdaq. We're down by 0.4% on the Russell as well. We're down by 0.7. Some economic data about across the Bloomberg terminal. This will become more and more important as the weeks and months progress with that data. Let's cross over to Bloomberg's Mike McKee. Good morning, Mike.
Good morning, John. You're right. We have a lot of new favorite indexes, including trade, and now the import price index. We also get export prices as well. Import prices fell on the month by 0.1%. Ex-petroleum, though, they're flat. The import price index on a year-over-year basis is up 0.9%. Exports were flat as well in terms of prices, but it's more about what the individual type of prices are that people are going to be concerned about. And what we saw last month was a rise in industrial supplies in terms of the amount of imports we got. And this time, import prices for industrial supplies, excluding petroleum, fell 0.2 after a 1.5% rise on the month. Now, one of the categories that rose a lot last month was metal imports, unfinished metal and finished goods related to metal because of the tariffs on aluminum and steel. Those were up 1.4% and 1.3%, so we are seeing some tariff effects there. The other number out this morning, Empire Manufacturing in New York, negative 8.1. That's better than we had last month, negative 20, but it still shows contraction in New York. New orders and shipments were down. A number of employees were down. Average work week was down. Unfortunately, both of the price indexes, prices paid and prices received, rose, and they are now at their highest in more than 2 years.
Mike, thank you, sir. We need to see that improve. Equity futures off the back of that, negative by about 1/3 on the S&P 500. In the bond market, yields lower at the front end of the curve. We're down by about 2 basis points to 3.82 on 10s at the moment, just about unchanged at 4.37. Let's keep it on trade. President Trump's tariff policy set to impact leadership at the state level. The Commonwealth of Virginia exporting nearly $22 billion worth of goods abroad last year, placing it in the top half of states and accounting for tens of thousands of jobs, according to U.S. government data. Joining us now, the Republican governor of Virginia, Glenn Youngkin. Governor Youngkin, good to see you, sir.
Great to be with you. Thanks for having me. It's super to be back in studio with you, so I just appreciate you making time for me.
Well, thanks for dropping by. Let's talk about how exposed you might be to this tariff push. You've got some very large aerospace and defense companies in the state. How are you helping those companies and individuals that might be affected by some of this in the meantime?
John, I think we have to step back first and put the current moment in the tariff evolution in context. From while he was running all the way up until today, President Trump has been really consistent on the elements of his economic plan. First, he's going to use tariffs to reset trade balances. And decades of bad deals, he's talked about it. You've heard these words out of his mouth over and over again. Second of all, he's going to make sure that manufacturing is reshored and that we reinflate or reinvigorate the hollowed out middle class. Third, we're going to reestablish fiscal responsibility in Washington. Fourth, we're going to reestablish energy dominance. And finally, through deregulation, we're going to make it even better to do business in America. And those elements are all in motion at the same time. The trade moment for us and the tariff moment for us is also this 90-day pause, which is giving the opportunity for deals. And every cabinet member has repeated there's 75 countries in motion right now. And I would expect that there will be some significant trade deals struck. I do think that there will be a level of ongoing tariffs. And the 10% number wasn't one picked out of a hat, and they call that the base tariff. You know, I'm a governor watching, but I do expect that there will be deals cut, and those deals, importantly, will be with some of our largest trading partners, India and Japan and Korea. And so this is what's going to happen over the next many months. And most importantly, I think that will bring some confidence to the market that this reset, which has to happen, and disruption is part of a reset, will open up long-term opportunity. Now, Virginia, we're seeing that long-term opportunity every day, and that's through our economic development pipeline. We've had an incredibly robust 3 years. We've had record investment or commitments from businesses expanding in Virginia, $100 billion in 3 years, by far the largest amount in that time period. We've seen record job growth. Virginia went from bottom third in job growth to top 3, 5, 10 every year in job growth. And that has allowed us to run surplus after surplus after surplus. The net of that is that we have open jobs in Virginia, 250,000 open jobs for folks to take. But on top of that, our economic development pipeline has been as full as it's ever been. And we're seeing businesses, international companies, want to come to the United States. We're viewed as the top state in America for business, and they want to come to Virginia. And so that's a really good foundation for us, as there is a period of disruption. But I think there's a long-term opportunity, and I think Virginia will really do well.
We can talk about the long-term opportunity in the fuller policy platform. I do just want to keep it on trade just for a moment. On trade, the methodology, it does feel like, was pulled from a hat in the last few weeks. And the criticism we hear around this table quite a lot, they will acknowledge the problem, and they will acknowledge that the president has articulated that consistently and well over the period of decades, not just weeks and months. It's the remedy to that problem. At the moment, what we hear from the bank CEOs, from investors, is this economy has drifted into a wait-and-see moment, that they aren't going to make those big CapEx decisions until they really know the rules of the game, the rules of the road. Do you think we'll know the answer to that within 90 days?
I think we'll see a lot of clarity over the course of the next, now 80 days, I guess, or 82 days.
I'm losing count.
But the net of it is that President Trump was clear. He's continued to be clear that in resetting bad trade deals over the last decades and reestablishing reciprocal trade opportunities, by the way, with nations that are our allies, China's a whole different topic, but with nations that are our allies, we just need fair trade, and we haven't had it. And so, to reset those trade imbalances, you see him do what he does well, which is create space for negotiating. And I think that's exactly what's happening. When the first weekend after April 2nd, you read in every publication that 75 countries had called within a day to start the negotiations, and you've already seen those negotiations, at least reported in rumor. I think this will be this opportunity to take a big step in resetting this.
Hold on a second.
And I think that's what the market needs to see.
Part of the problem, I think, and you know this very well, having invested heavily as a co-CEO of Carlyle and been investing in infrastructure, which takes a long time, there's a maturity mismatch between when some of this negotiation is happening, when these tariffs go on, and how long it takes to bring that investment to the United States. There is a lack of clarity about whether those policies will be continued in perpetuity, and it's leading to paralysis at so many companies. What do you tell the companies in your jurisdiction who come to you and say, how can I plan? How can I hire? How can I invest when this could change, when I don't even understand the parameters we're talking about?
Yeah, I have to disagree with you on the long-term planning, because we're seeing a pipeline of economic investment that has been as full as it's ever been, and these are long-term investments. Fortune 50 companies wanting to build in America and in Virginia, hopefully, if we can recruit them there. And these are long-term investments. And you saw NVIDIA yesterday talk about $500 billion. We've seen most of the big pharmaceutical companies commit to building in the United States. We're seeing technology investments, advanced manufacturing, all in the United States. These are long-term investments. I think the difference in a lot of people's understanding is that during market ups and downs, well, yes, IPOs get postponed, and yes, corporate deals get postponed, but these long-term commitments are actually coming in very large numbers, and that's good for states like Virginia. I mean, listen, we're in the SEC of economic development. I compete every day with Tennessee and North Carolina, South Carolina, Georgia, Florida, Texas, and we've got to compete. And I think that much of that investment will come to this region, and that is a long-term commitment. And so The uncertainty in the near term, yes, I get it, I understand it, but the long-term expectation that America is going to be the best place in the world to invest is clear and real, and that's what we're seeing in our economic development pipeline.
There's also an issue of staffing all of this up and how we do this, where not only is there a maturity mismatch, but also potentially a skills mismatch. And I know that your state has been significantly affected by some of the DOGE cuts, and you've talked about that and how you plan to provide for some of these workers, but how do you reskill people to work for different types of jobs, given that they've worked in a very specific field and there might not be jobs in that field, and what we're trying to build up hasn't been there for a long time?
Well, first you go to work and prepare an education and training ecosystem to do exactly that. And we've been doing this for the last 3 years in Virginia, which is resetting the career paths and the education paths for lots of Virginians with opportunity. And today we have an incredibly high labor participation rate. It's bounced back from lows during the pandemic and the previous administration to near one of the national highs. We have one of the best workforce training programs in America. We were just named for the 3rd year in a row of having the best customized job training program in America. This is what you do. You go to work. I do think that the expectation that there will be job losses, particularly out of the federal government, is real. We haven't seen them yet that much in Virginia. I mean, our first-time claims and unemployment are still at historic lows. But listen, I do think that the federal government downsizing is necessary. Listen, we're at $37.5 trillion of debt, $2 trillion a year of incremental debt. We can't do that. And so resizing the federal government and recognizing fiscal responsibility is critical to the future of the country is real. What does that mean in a state like Virginia? We have a lot of federal workers, a lot. Now, a disproportionate amount of those are in the defense and in the intelligence and national security area, and we're seeing more money go into those areas. But I still expect that there will be real disruption for some folks in Virginia. My dad lost his job twice when I was growing up, and I've seen this in families my own, and it is really hard. And that's why a pathway to a new career is so important. Because of our economic growth, we have 250,000 open but unfilled jobs in Virginia. And over 100,000 of those require a bachelor's degree. These are good jobs, but they're also jobs that pay well. And so opening up that pathway to folks who find themselves with job loss is really, really important. And so we launched something called Virginia Has Jobs. And it's for folks to get jobs in Virginia from all over the country. But at a time when we're seeing this dislocation from the federal government, it's a real opportunity pathway. 250,000 jobs, pathways for training, coaching, resume writing, but also for making sure folks know how to file for unemployment and keep their health care. This is a pathway that I'm really hoping that people who do have job disruption can find a way to a great career in Virginia, because Virginia has lots and lots of jobs, and people can go to virginiahasjobs.com and actually find one. And that's part of, I think, this movement of really public sector employment to private sector employment. And we've seen it in Virginia. We've had great job growth over the last 3 years. It's led to record surplus after surplus after surplus, which has allowed us to reduce taxes. It's allowed us to invest in education and in law enforcement. And by the way, in economic development and job training. But it's also, I think, changed people's view of long-term in Virginia. We used to have, for 10 years, we had more people move away from the Commonwealth of Virginia than move into from the other 49 states. And last year, we became one of the top importers of talent in America. So this works. And at a time when President Trump, again, is trying to run a very, very full policy agenda, resetting trade, balancing the federal budget, making America dominant again in energy, reshoring manufacturing, and restoring this middle class, which has been eviscerated over the last 20 years, and doing all of that while deregulating to make America even a better place for business. I think we can look at Virginia and say, hey, we've seen at least a little microcosm of that, and it works.
Governor, the stakes are high. I'm pleased you mentioned your experience growing up. You, like me, we were professional dishwashers. You went on to have a fantastic career leading Carlisle, and now you're dedicating yourself to public service. There are now people much younger than us who believe that dream is not available to them, that upward mobility is no longer something available in the United States. And at the moment, as you know, filling stadiums around this country as left-wing people like Congresswoman Ocasio-Cortez, Senator Bernie Sanders, if this administration gets this wrong, we could see a swing in the pendulum all the way to the far left. It's not unthinkable. You can see that taking place. How high are the stakes? What happens if this administration screws it up?
Well, I first and foremost don't believe they will. And therefore, I think what people will see over the course of this administration is the realization of this long-term opportunity. And that's why all of the elements that in play are critical. You know, there are so many people in government who believe there's one policy solution, this magic wand that will fix everything. This is an incredibly complex economic transition model. And that's why having all of the elements in play at one time, while complicating, is critical, because they're each going to contribute for the long-term success. And if you peel out one, you know, energy dominance. Listen, getting energy prices to a place where they're sustainably affordable at the gas pump and in the supply chains, critical. America should basically dominate the world of power and energy. Making sure we have a balanced fiscal moment, not running $2 trillion deficits, critical for the long-term success of America. Reshoring manufacturing, and think about what's happened over the last decades, where we watched critical, very high-paying jobs move around the world away from America and hollow out our middle class. That's the opportunity that has really been missing, because we've seen literally the middle class not participate in the economic growth of America over the past few decades. This is what this opportunity is all about. And I've said many times, I think the number one job we have as Americans is to help this administration be successful. And that success will translate into an even better America than we have today.
We've said it around this table. We hope they are. Just a final question. What's the future of Governor Youngkin? What do you want to do next?
Well, I finish up next January, and I just want to begin by saying this has been the most purposeful moment in my entire professional career, and I've loved it. And I want to make sure this last year is incredibly productive for Virginia. Listen, you only get 4 years in a governor's job in Virginia, and I've got 1 year left, and I got to get 4 years of work done in this year, because we've had a great first 3 years, and I want to get a second term jammed into this last year. But I also recognize that there are a lot of folks who spend all their time planning for their next job. I'm not one of those folks. I'm going to spend 100%, if not 150% of my effort making sure that Virginia continues to thrive. We've got a really important election this year. Our Lieutenant Governor, Winsome Earl-Sears, has been a great partner for me through this entire economic revival in Virginia, and I want to make sure that she gets the baton. I think voters will trust us and trust her and want to elect her the next governor of Virginia, and then we'll decide what I do after I've watched her be inaugurated.
Youngkin Vance, 28.
I'll decide after I'm done in January 2026.
I had to try, Governor. It's good to see you.
I will repeat, though, the most important thing that we need to be doing right now is to be helping this administration be successful. And I think the elements are in place. It is a complicated set of movements in order to reset so many things at one time. But I have great faith that the long-term opportunities really are going to be great, and we're seeing that in companies who are investing all across Virginia and America.
For the good of this country, I think a lot of people agree with you. We hope you're right. Thank you, Governor. I appreciate your time. Thank you, sir. The Virginia Governor, Glenn Youngkin there. Thank you very much. With an update on stories elsewhere this morning, with your Bloomberg Brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Bank of America and Citi rounding out the big bank earnings for the quarter with big trading results. Bank of America beating estimates on total trading revenue and net interest income. Citi, for its part, delivered better than expected sales and trading revenue as well, moving closer to its profitability targets. Elsewhere, China has ordered its airlines to stop taking deliveries of Boeing jets. Sources tell us that Beijing also asked carriers to halt purchases of aircrafts, related equipment, and parts from U.S. companies. The Chinese government is also considering ways to assist airlines that lease Boeing jets and are facing higher costs. And it's day 2 of Meta's antitrust trial set to kick off today. Federal prosecutors are looking to prove Meta bought its way to a social networking monopoly. Mark Zuckerberg took the stand yesterday for more than 3 hours, testifying about the company's 2012 purchase of Instagram. He's expected back today. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the program, we'll set you up for the day ahead. Plus, we'll catch up with Krishna Mamani of Lafayette College. From New York City, this is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Equity futures on the S&P just a touch softer. We're down 0.25%. Coming up through the week, this is what it looks like at 2:30 p.m. Eastern Time later on today. President Trump signing executive orders. Then United Airlines results coming after the closing bell tomorrow. Retail sales and Fed Chair Jay Powell speaks. Thursday, an ECB rate decision plus another round of jobless claims before we get earnings from Netflix. Joining us around the table for final thoughts and a look ahead to the trading day, Krishna Mamani of Lafayette College. Krishna, good morning to you, sir.
Good morning, sir.
I remember a number of months ago and you said you don't want to be in stocks, you might be better in bonds. What now?
I think it's still the same. That is, the reason not to be in stocks is because the upside is limited. That is, they're not cheap. And on top of that, you face all sorts of economic and actually existential uncertainties. In that environment, expecting it to kind of go back up in a meaningful way, I think is just not realistic.
How much do you buy into this idea that Sell America is the trade and is going to stick around for a long time?
Well, so yeah, that, you know, there are a whole bunch of people in this world who would like that to happen. But I think the real question is, how likely is that? And I think if you kind of evaluate that, then, okay, they don't want to be here. Where else do they want to be in? You know, it's not that Europe is lighting the fire or even some of the emerging markets away from India are that superlative. So I think this is a good thesis, but I don't think it'll work out that way. If the U.S. markets don't do well, other markets may do somewhat better on a relative basis, but on an absolute basis, expecting them to do meaningfully better on a, in positive returns, is not in the cards.
That said, we've heard so many different analysts talk about the possibility of stagflation. How do you rearrange your outlook longer term and your asset structure based on that type of discussion of a stagflation in the United States?
So I think Waller kind of hit the nail on the head yesterday, which is he brought in the transitory word that nobody likes. But I think the key point that he was making was that, yes, tariff will lead to a higher price level, but not necessarily inflation. And I think that's realistic. That is, in a really bad scenario, the most likely outcome is that we go into a recession. I think expecting inflation to remain meaningfully high in that environment, given the structure of the economy, it's a possibility. I wouldn't bet that as a significant probability.
Rude question. Is Governor Waller saying those things because he believes it's right for policy or right for his career and his next move?
No, not at all. I think if you look at it, it's a really fair question. And I would say that based on all the things that he has said on a consistent, I have a great deal of respect for him to be saying these things in the middle to a politician who wants to further his career. And I think he's being very truthful.
Is it easier to say when the rest of the committee is out there prioritizing anchoring inflation expectations?
Well, so I think the rest of the committee is thinking about in certain ways, and I think it is important for us to hear Waller's viewpoint, because I think from a doctrine standpoint, he probably carries more weight in that committee than anybody else. Everyone else is, they're significant theoreticians, but I think Waller has a great deal of credibility based on what the outcome has been based on his forecast over the last few years.
A phrase Lisa and I have heard repeatedly through the morning: calm before the storm. This is calm at the moment, relative to last week, certainly the calm after the storm. Do you think this is the calm before the storm again? And is the storm in the data?
Well, so that's actually, again, a very good question. I think the likelihood of us seeing the sort of storms that we saw last few weeks, since Liberation Day, I guess, I think I would assign low probability to that, because the moment that starts happening, you anticipate some sort of a policy initiative. So it's like the Fed put in a different context. Government put as opposed to Fed put in that. But I think what we are actually going to see is probably slow deterioration in the growth trend. Not a catastrophic drop, because there's enough momentum in the economy, but a slow deterioration that will probably manifest itself in the second half of the year rather than during the summer.
And Lisa, some people think that process has already commenced, already started.
Which is the reason why, even though there's been a pivot or some sort of past of the uncertainty, people are still baking in that chance of some sort of downturn.
Christian, it's good to see you.
Good
Thanks for
as
dropping
well.
by. Christian Mamali there of Lafayette College. Equity futures a bit softer here. We're down by 0.2%. Coming up tomorrow, Jack Caffrey of JP Morgan Asset Management, Alicia Levine of BNY Wealth. We'll catch up with the former House Majority Leader Eric Cantor and the United Airlines CEO Scott Kirby. From New York, this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country, and how many people have another problem called illiteracy or illiteracy, right, which means they can read, but they don't choose to read?
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an ebook, you're reading the book, and I've been often asked, if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It is tax day. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shanali Basak. And I'm Katie Greifeld. Bloomberg Open Interest starts right now. Coming up, automakers get some relief, but more tariffs could be coming soon. President Trump starts probes on pharma and chips.
China grounds Boeing. Beijing orders its airlines to stop taking deliveries from the U.S. plane maker, escalating the trade war.
And Bank of America and Citi wrap up big bank earnings with record results, while J&J kicks off earnings from Big Pharma. So let's get into that right now. J&J maintained its earnings outlook despite the potential for tariffs on the pharmaceutical industry, but that is what is weighing on the stock right now, Matt, down 1.5%.
All right, and we're also looking at Boeing shares right now down 3% after China ordered companies to halt Boeing jet deliveries as well as purchases of parts from U.S. companies for any of its aircraft.
Watching the banks here, Matt, because of course they did maintain their guidance as well. Bank of America and Citigroup, the latest banks to report a spike in trading revenue amid global tariff volatility. Bank of America CEO says investors are facing a fast-changing economic future, Katie. And a lot of that future depends on just how the U.S. trade war plays out. Yesterday, Treasury Secretary Scott Bessent told Bloomberg Television that current tariff levels are at the high end in order to spur negotiations.
Well, look, the Treasury has lots of things we can do, and but again, I think we're a long way from that. But again, we have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted.
All right, Scott Bessent there talking about the tools that are at his disposal if yields rise too far too fast. The Trump administration also has initiated trade probes into semiconductor and pharmaceutical imports, which could lead to more tariffs. Bloomberg's Tyler Kendall is at the White House with the details. Tyler?
Yeah, hey, Matt. So the administration has formally announced those Section 232 investigations into semiconductors and pharmaceuticals, largely seen as the precursor for the administration to impose tariffs on the basis of national security concerns. Now, we've learned that the administration actually started these probes back on April 1st. That means that the Commerce Secretary, Howard Lutnick, now has 270 days from then, roughly 9 months, to complete his findings that would then spur the tariffs. However, we know that this White House would like to see this done under more of an expedited timeline. Lutnick himself has said that we could expect to see them imposed in the next 1 or 2 months. Now, I actually had the chance to speak with one legal expert who told me that the fact that this White House is looking to impose these sector-specific tariffs under Section 232 very likely means that they're looking for a more durable legal basis here, which could result in these tariffs being on for longer compared to some of the other emergency powers that we've seen invoked, perhaps for the so-called reciprocal tariff plan as one example. We should also say that these investigations are pretty broad-ranging. They include pharmaceuticals, but also the ingredients that go into pharmaceuticals. They include chips, but also the equipment used to make chips, and then those downstream products like consumer electronics that have chips in them. Matt, I'll also just quickly add that this White House has opened the door to potentially some negotiations with the private sector. President Trump said over the weekend he would be open to some product-specific exemptions when it comes to tech imports, and as you well know, said yesterday that he could potentially be issuing at least a temporary reprieve for those automakers who move part production to the U.S.
All right, so a fluid situation to say the least. Bloomberg's Tyler Kendall joining us from the White House. We'll get into all of those sector-specific tariffs in just a few moments. But let's talk about Boeing, because Boeing is the latest target in the U.S.-China trade war. Beijing has ordered its airlines to stop taking deliveries of Boeing jets and to also halt purchases of aircraft-related equipment and parts from U.S. companies. Bloomberg's Sid Phillip covers aviation. He joins us now to explain. So, Sid, I'm wondering if this is more symbolic than anything else, because this comes after China unveiled retaliatory tariffs of 125%. So it already would have been too expensive to keep up with these purchases?
It would have, because, I mean, obviously, when you're buying a $100 billion plane, 125% on top of that would make it sort of impossible for the airlines. And also, it would sort of make it impossible for the airlines to continue buying parts from America, especially since the tariffs are also on those parts. And so it is symbolic, but it's also sort of a massive blow to Boeing, because obviously China is a huge market for Boeing. Boeing expects it to be about 20% of its market going forward. And it was about a quarter until 2018 when Boeing was stopped selling the MAX because of the crashes.
Does that mean that they won't be buying any planes going forward, though, until negotiations happen?
It does look like that. It does look like the Chinese government has told the airlines to stop taking deliveries of Boeing aircraft until such time as they can sort of reach a deal. I mean, that's the underlying message, that essentially until there is some sort of agreement between the US and China, Boeing planes are off the menu for the airlines in China.
Sid, we thank you for your reporting. That is Sid Phillip of Bloomberg News. We're going to turn now to bank earnings, because Bank of America posted record trading revenue in the first quarter. Citigroup's revenue helps it get closer to Jane Fraser's profitability target. RBC Markets head of U.S. Bank Equity Strategy, Gerard Cassidy, joins us now. Positive reaction, fairly positive guidance here across the board, really. Still a lot of caution, a lot of investors still worried about capital markets, a deal freeze, CEO sentiment. Where is your head at right now after we have all the information, Gerard?
Sure, thank you for having me on. And what we saw across the board from all of the big banks is that trading results led by equity trading were at record levels for many of them. The investment banking activity, as you pointed out, was generally lower than expected because of the uncertainties in the market. So as we move forward, as trading results remain, volatile, or I should say trading markets remain volatile, the trading results should probably continue to be robust in the second quarter, but the investment banking activity is likely to remain on pause. In fact, the JP Morgan even indicated that they're lowering their expectations for some of the ECM business or the IPO business as we go forward. The other important trend, though, in this quarter is credit quality for the industry remained very strong, and the capital levels and liquidity are very healthy. So the industry is prepared for any slowdown that may come as a result of the Trump administration's tariff policies.
And Gerard, I just want to step back, and now that we have, all the big ones out of the way, just what this says about where we are. These banks are looked to, and these executive comments are looked to as sort of a bellwether when it comes to the U.S. economy, when it comes to basically the health of the U.S. consumer. It was only JP Morgan, I think, that set aside more than expected for loan loss provisions. You really didn't see that from its peers, and I wonder, when you boil it all down, what are you left with?
Many of the banks looked at the reserving of their for their portfolios. As you might recall, the industry had to shift the reserving methodology in January 2020 to factor in the outlook for the economy and the impact it may have on the loan portfolio, known as CECL accounting, current expected credit loss accounting. And so everybody did that in the quarter. It turned out that JP Morgan's build was about $1 billion, but other banks looked at it as well, and they built up reserves, but they also had some reserve releases in other parts of the portfolio, so the net increase maybe was not as large. But all of the banks are building the reserves in anticipation of higher unemployment based upon their analysis.
It's interesting you end with unemployment, because I was going to ask about banker jobs. How does it look for, Bloomberg clients watching BTV right now? Are their jobs guaranteed for the year? Is this going to be a good year for bonuses, or is the uncertainty in the economy also leading to uncertainty for them?
It's interesting because the traders are certainly, if this activity continues throughout the year, that part of the business should see strong bonuses, and employment will remain very healthy. But on the investment banking side, you have to question if this first quarter is carried out through the entire year, then certainly revenues will be disappointing and bonuses won't come in as strong as maybe some people had hoped, and maybe there will be some headcount reduction as well. Too early to make that call, but certainly that's something that should be looked at as we get through the second quarter and we enter into the summer months.
One question I have, Gerard, is do these bank earnings that we've seen so far really give a bigger picture of the economy? You looked at Bank of America. They did something I don't remember them doing for a long time. They gave you their FICO scores relative to where they stood in the end of 2009. And currently with an average FICO of 777 for a credit card at Bank of America, it's hard to believe that their credit quality says something about the rest of the financials and the larger consumer picture that really exists in America.
It's interesting. Bank of America, as we all recall, came close to failing back in 08, 09, and under the leadership of Brian Moynihan, he's turned the bank around and has built up a very strong balance sheet, very similar to the other large banks like a JP Morgan. And that slides that they're distributing, and they have done this before, they really want to show investors how they've changed since those dark days in 2009, and he has de-risked the balance sheet. And that shows up, as you pointed out, in these FICO scores for the consumer, but also in the corporate and commercial lending area as well. But this is true for the industry. You know, the banking industry is not generally a subprime lending industry. That's obviously the non-banks. But the banks on the consumer side have prime credits and super prime credits. However, in a rising unemployment market, you know, the rate of unemployment by the end of this year reaches 6%. Rest assured, the consumer credit losses will go up in that kind of environment.
Yeah, a 6% unemployment rate would truly be stunning. Let's hope it doesn't come to that. RBC's Gerard Cassidy, great to spend some time with you. Let's take a check on these broader markets right now. You can see the S&P 500 just about unchanged. The NASDAQ 100 not too far off those levels, while small caps fall a little bit. The S&P 500 coming off 2 straight days of gains. We're looking for a catalyst right now, and maybe it'll come from the White House, because coming up, the Trump administration moves to put tariffs on chips into motion. We'll take a look at the potential impact next. This is Open Interest.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. Treasury Secretary Scott Bessent has has watched the recent bond market sell-off, and he's got ways to deal with it. In an exclusive interview with Bloomberg's Anne-Marie Horton, he said the search for Fed Chair Jay Powell's successor will be underway soon.
Well, we think about it all the time. I think when are we going to start the interviewing candidates? And that'll be sometime in the fall.
Powell's term runs out in May of 2026. President Trump chose him to lead the central bank back in 2018. Caterpillar has a new CEO, Joe Creed, a nearly 30-year veteran of the ag machinery giant, will take the reins from the current CEO, Jim Umpleby, effective May 1st. Creed, who is currently the company's COO, is stepping up at a time of heightened uncertainty for CAT. The company warned in January that full-year revenue will be lower thanks to declining sales. And the Trump administration is freezing over $2 billion in federal funding for Harvard University. It happened hours after the elite college rejected a list of demands from the government that were said to be designed to fight anti-Semitism on campus. But the president of Harvard says the request crossed red lines regarding academic freedom and interference in higher education. Sonali?
And we're going to turn now to chips, because the Trump administration is starting a probe into semiconductor imports. The move is seen as a precursor to tariffs on critical goods like microprocessors. Joining us now, Mandeep Singh of Bloomberg Intelligence. This is so much more targeted than we've seen with the blanket tariffs so far, and they're going for the heart of the infrastructure. It seems like a lot of companies will be treated very differently. I'm sure we're going to ask a lot about NVIDIA, but I actually am equally curious about what it means for the likes of a TSMC.
Yeah, look, I think what they're going after is critical infrastructure, and really, semiconductors is of national security importance. And that's why this is, from going from reciprocal tariffs to sector tariffs. And when you think about semiconductors is almost like 12 to 15% of global trade. So this is like as big as anything you can get in terms of global trade. And you want to study the supply chains, because like if you're importing laptops, it's very different because it's an end product, whereas semiconductors is what China is importing in turn. So like the supply chain aspect is critical, because China is exporting rare earth, they're importing chips, and once you know exactly where the key kind of pain points are, and TSMC is definitely one of them, because they are the ones who are the manufacturing hub for advanced nodes. That's when you work on those companies, which is what they did with NVIDIA and TSMC announcing yesterday that, they are setting up this facility for AI supercomputers. And then you expedite the permits for those type of, companies. And I think that's the approach they're going to take going forward compared to the blanket tariffs, the reciprocal tariffs that came.
So you mentioned NVIDIA, but talk a little bit more specifically about NVIDIA. It's still one of the biggest companies out there, and it really sets the tone for sentiment when it comes to the AI trade and, in some respects, the broader tech trade. So where does this leave NVIDIA potentially, this probe?
Yeah, so I'm thinking, the supply chain for NVIDIA servers is very different from a supply chain for Apple smartphones, for example. And, a smartphone has thousands of components, whereas a server has, to an extent, fewer components than what goes inside a smartphone. So when you think about giving companies incentives to relocate their complete supply chain, it has to come from NVIDIA as the company or Apple as the company that really creates the product, using a global supply chain. And I think that seems to be a much more practical approach in terms of bringing manufacturing back, because that's the end goal, reshoring of all these products here in the U.S.
In terms of national security, the New York Times had a great story during the Biden administration about how NVIDIA kind of got around the rules and actually was selling these really high-tech chips to China, which then turns around and uses them for its military purposes, among others. Is the Trump administration going to be able to really clamp down on NVIDIA so that they don't find, ways through Singapore to get chips to Beijing?
Absolutely. I think that is part of this probe that is set up, is not just to look at the imports when it comes to the supply chain, but also the exports of restricted chips. the semi-cap equipment, the ASML machines that you need to, set up your fabs. So clearly there is that aspect in terms of figuring out how they were able to get around the export restrictions and what that means in terms of their ability to, create chips for training LLMs, like DeepSeek controversy, where how many NVIDIA chips did they have access to. So all these things, I think, are part of this probe, and that is what will determine how they kind of work around reshoring some of the manufacturing for these products.
And the story is just beginning. Mandeep Singh of Bloomberg Intelligence, we appreciate all of your analysis. And we are less than 12 minutes to the opening bell. We're going to begin the trading day with Sinead Colton-Grant of BNY Wealth. Stick with us. This is Bloomberg Open Interest.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Well, Bank of America's latest monthly survey highlighted some serious angst for investors. 82% of fund managers expect the global economy to weaken, and a record number intend to reduce their exposure to U.S. equities. That is the most negative investor sentiment read in 3 decades. Joining us at the desk to break it down is BNY Wealth Chief Investment Officer Sinead Colton-Grant. Sinead, great to see you with us.
Thanks, Katie.
So let's talk about this survey. Of course, it turned a lot of eyeballs this morning. Folks worried about just how bad it feels out there. From where you're sitting, from the conversations that you're having with your clients, are you hearing some of the same remarks?
Well, I think, first of all, just in terms of the survey, let's remember the time frame, because it was before we had the 90-day pause. That's when really sentiment was at its lowest. But look, when we think about the tariff package that was announced, that clearly is going to shave some growth from the U.S. If the U.S. sneezes, the rest of the world catches a cold. And so equities, you think about fundamentals, that's going to bring down earnings expectations both here and outside the U.S. So our clients are asking, what's going to happen with the U.S. economy? What's going to happen with the consumer? And we need more certainty from the administration on what they're agreeing in terms of tariffs with individual countries now that we have the 90-day pause.
But Sinead, in terms of what fund managers want to do, I thought Bank of America had a striking chart showing that I think about 50% want to be underweight. And as it stands, they're only net 36% underweight. So it looks like we have more room to fall further on the S&P.
Well, let's think about what markets are pricing right now. There's roughly a 50% chance of recession being priced in. So, yes, we've seen a bounce over the last couple of trading sessions, but that feels about right to us. So we're neutral on equities. We had been overweight. We reduced that a couple of weeks ago. And do you want to go underweight stocks from here? Well, let's just think about the very strong reaction we had in markets over the last couple of sessions when we got some more positive news. So I think that's telling you a couple of things. One, we're probably pretty fairly priced here given what we know. The situation is fluid, true, but given what we know now, it's fair. But the second is that there's a huge desire to buy in. So if you decide to go underweight, you better be prepared to move very quickly.
Well, that was going to be my question. I was looking at the sectors performing this year so far, and it's not a lot. Most sectors in the S&P 500 are still in the red, and if you believe we're going to get to 5,600, we're around 54 right now. Why not buy? Is there too much worry about more downside risk from here?
Look, I think fluid is the key word in terms of the situation because there's a lot that we just don't know. And that's why you had such a strong market reaction when the tariffs were announced, because they were a lot more than had been anticipated. The big outstanding question is the tax package. So the consumer has been driving a large part of the U.S. economy. We know it's been the top 10% of consumers that have really been spending. And so if you're going to hit the consumer with higher prices, the risk is that if you don't have an offsetting tax package, that really causes them to pull back. And frankly, we're more concerned about growth than inflation as a result of tariffs.
Right, and the administration has teased that, taxes, something on taxes might be coming in the second half, but certainly feels far away at this moment.
Also, that's just an extension, right, of what we already have. That's not a tax cut.
Something on taxes. Yeah. Sinead, you're sticking with us through the opening bell. A really interesting note that you made on positioning there, and you have to wonder if everyone is rushing to one side of the boat, maybe you want to get on the other side. Maybe it could be skewed as a bullish signal there, but we're going to discuss all of that and more with Sinead coming up at the opening bell. Your setup heading into the ringing, you can see the S&P 500 pretty much unchanged. It's been there for a couple hours now. The NASDAQ 100 trying to build on some of the momentum it's picked up over the last 2 days, falling a little bit flat, and then the Russell 2000 also seeing some red. The open is up next. This is Bloomberg.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. There's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We are moments away from the start of trading on this April 15th. It is, unfortunately, tax day. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at really little change on S&P futures right now. As Katie mentioned earlier, we've had a couple days of gains. We're looking at a NASDAQ that is gaining in terms of the futures picture. Small caps are down a little. Opening bells ringing at the New York Stock Exchange and the NASDAQ. The NASDAQ is here. No, this is still futures. That's the NASDAQ. Okay, Virtu celebrating 10 years of listing on the NASDAQ, and I looked back over those 10 years. If you invested and reinvested dividends, you've tripled your money there. But at Caterpillar, you've done even better, up 350% over 10 years. So they have both been pretty good bets. Katie, in terms of the stocks that we're watching this morning, what are you seeing moving?
Well, I've got my eyes on J&J because the company maintained its earnings outlook. That's despite the potential for tariffs hanging over the pharmaceutical industry. You can see shares turning around a little bit relative to the pre-market, Sonali, currently up almost 1% if you're feeling optimistic and want to round up.
Yeah, if you're feeling optimistic over here, Bank of America and Citigroup on the rise. They are the latest banks to report a spike in trading revenue amid global tariff volatility. I will say both also held their outlooks for the year. Bank of America now up more than 4%. Citigroup up almost 2% right after the open.
All right, in China, as we've been talking about, ordering a halt to Boeing jet deliveries, as well as purchases and parts from U.S. companies. But of course, with 145% tariffs,
right?
Those planes would be too expensive to buy anyway, wouldn't they?
So it's a little bit symbolic, but still symbolism worth noting.
All right, we have still with us BNY Wealth CIO Sinead Colton-Grant. And you know what? I was looking, Sinead, at ChatGPT and trying to get it to give me a list of all of the tariff announcements that Trump has made, along with dates that the tariffs went into effect, times when he rescinded tariffs, and then carve-outs, right? I just wanted a bullet point, like, timeline. And AI could not give it to me. It just wasn't working. It's just too much information and too confusing. If it's that hard for, OpenAI, how difficult is it for your average CEO?
Well, look, I mean, you really need to think through what the potential implications are, but what every CEO wants is certainty. Certainty so that you can make decisions around investment, certainty so that you can make hiring decisions, and absent that, you pull back on spending. And in fact, this is one of the things that really concerns us about the uncertainty and the fluidity around tariffs, which is that if you're in that seat and you need to make a decision about, do I spend today, or do I make that decision later, you are going to defer that decision, and that includes hiring decisions.
And I do just want to break some news here. When it comes to trade policy, Canada to give a 6-month tariff relief on some U.S. goods. So just to read that again, Canada coming out with 6-month tariff relief when it comes to some U.S. goods. You take a look at the S&P 500, moving higher right now up about 0.3 to 0.4%. Some wiggling there when it comes to the U.S.-Canada relationship, maybe a little bit of thawing. So again, it sort of speaks to how fluid this situation, how quickly things are moving. It's hard for executives. It's also hard for investors. But I want to go back to the positioning conversation that we were having before the break, because at least according to the Bank of America survey, things are feeling pretty negative. You have investors planning to further offload U.S. equities. And I want to bring you the question that I asked Matt. Does that create sort of a bullish counter trade there? Maybe it's time to get long if everyone else is doing the same thing?
Well, let's look at what history tells us in relation to that. It's always darkest before the dawn. In other words, the sentiment gets really, really poor right before the market bottoms. And the market is looking 12 to 18 months out. It's not looking at exactly where, how things are today, right? So yes, look, if you're going to take a 12 to 18 month time horizon, you assume that growth in the US rebounds, then we're getting close to the point where you may want to add a little bit to equities. And look, I think being short equities here is a challenge unless you are incredibly dynamic and can trade quickly.
So what about other places outside of equities? At this point, do you think that given how much we've seen equities sell off, you are getting, frankly, since Liberation Day, more positive headlines coming through, like this Canada pause, as we've been talking about? You're seeing the S&P turn around, the Trump administration themselves walking back some of the toughest that you've seen. Treasury Secretary Scott Bessent basically saying that they set a high bar here, right? And now it's about negotiation. The assumption you're seeing from investors is negotiating back from that. So why is it so hard for people to call a bottom?
I think there are two things happening here. The first one is that the market has a little bit of PTSD because it was so shocked on Liberation Day, and you're seeing hesitancy around anyone getting a little bit ahead of what's actually announced. But the second piece, Shonali, that I think is really being missed here is if the US growth is coming down, that means growth around the world is coming down. And what we should really focus on here is what are the agreements that other countries are making with the US? How are they thinking about their exposure to China? Because frankly, if you're in the EU right now, you're looking at a wall of China exports potentially coming to your markets. And we've seen how poorly that played out for the auto industry in Europe. So you've got to think that behind the scenes, there's a realignment across trading policies generally outside the US.
Where is a good safe haven now? Because treasuries have been difficult, right? The dollar has been poor. Obviously, the Mag 7 is no longer the safe haven it once was. So what do you think?
So look, if you really want a safe haven, you want the Swiss franc, and that's actually behaved in the way that you would expect. I actually think the behavior of the dollar has been quite unusual, right? When you've seen treasury yields going up, usually that would mean higher rates, a stronger dollar. You've actually seen the dollar weaken. I think that's more of a temporary phase. I think the dollar will return because if we're looking at weaker economic growth around the globe, that should weaken the euro, that should weaken the pound, and it should weaken the yen, frankly. So, but as of today, I think the safe haven that's acted in the way that you would expect is really the Swiss franc. But if you want to look at equity markets, if you want to take a little bit more risk, utilities can look interesting. And that's not just about, you know, the traditional utilities, but also thinking ahead about demand for electricity for many of the new technologies that we see coming on stream.
Sinead, we thank you so much today for helping us navigate what has been a very complicated environment for investors. That is BNY Mellon CIO Sinead Colton-Grant. Now, I want to bring you some breaking news as well from our Bloomberg team. Elliott is said to build over a $1.5 billion stake in HP Enterprise. They are working with the company. They plan to engage with the software and networking company to boost value. Of course, this is according to people familiar with the matter. The details have not been made public. It is one of the company's top 5 investors right now, according to data compiled by Bloomberg, and the exact intentions could not be immediately learned. You're seeing just the shares soar. Matt.
Yeah, it's interesting to see this, and I wonder if we see more purchases by people or funds with cash, right? I mean, obviously Warren Buffett.
We saw
KKR, $8 billion in deals,
Stunning.
right? This week, and obviously Warren Buffett, we've been talking about how much cash he has. He's been selling into this downdraft, and so he has a lot of dry powder.
Yeah, absolutely. We'll see if Warren Buffett finally makes a move. It's something we've been waiting for several years. We do want to get back to that Canadian breaking news. This coming from a press release from the Department of Finance in Canada that Canada is going to give a 6-month tariff relief on some U.S. goods. A little bit more detail there. Some automakers will be eligible for exemption from Canadian tariffs. Canada announcing a remission framework for the auto industry. So we pulled up some of the automakers here, not really moving as a block right now. You have GM, you have Ford down on the day. Then you see Stellantis, maybe Tesla moving a little bit. Ford is pretty heavily reliant on the U.S., isn't it?
Well, Ford is, of the big three, assembling the most of its vehicles in the U.S., right? Only 25%, I think, of Ford's vehicles are assembled in Canada or Mexico that are sold here. GM, it's closer to 35%, and Stellantis, it's over 40%. But you could argue that some of these moves were yesterday. As we start to see more carve-outs, as we start to see more tariffs rescinded, maybe investors have said, okay, he's not really going to go through with this. And General Motors today is soft. Yesterday was up 3.5%.
And a lot of this does have to do with automakers. They do give a real recognition of the integrated nature of the North American automotive sector, but they do also have other goods privy to that 6 months relief, including goods used in manufacturing, processing, food and beverage packaging, and things for public health, healthcare, public safety. So very interesting how targeted these nations
And this is Canada maybe trying to do a little bit of negotiating before they sit down with Scott Bessent, right?
Yeah.
Saying, hey, we'll give you, this is an olive branch, maybe you could see it as.
Yeah, and it's interesting, again, to parse through this press release. When it comes specifically to the automakers and those remissions, the remissions granted to these companies is contingent on these automakers continuing to produce vehicles in Canada and on completing those planned investments. The number of tariff-free vehicles a company is permitted to import will be reduced if there are reductions in Canadian production or investments, so clearly setting the stage for those negotiations.
Great call out, because you have to wonder if Scott Bessent is going to say, okay, we'll let you take our manufacturing there.
Well, no, and you heard President Trump the other day saying he may give automakers a reprieve because many of these automakers are producing in Canada and Mexico, and they want to move that production to the U.S. I will also say it's not terribly easy to sell U.S. vehicles in Canada already. The prices are much higher.
Right.
And you don't want to buy a used car from Canada because you don't know the history. That means residual values are lower. Yeah, who knows what they're doing with their cars up there.
We are going to now get a look at more stocks moving under the hood. We're going to bring in for that Isabel Lee, Bloomberg News.
Hey, Shonali, we're looking at Applied Digital. It's edging lower by more than 20%. So the company reported third quarter estimates that missed forecasts, especially for revenue and adjusted EBITDA. So Applied Digital is a company that builds and operates big, powerful data centers to support artificial intelligence and cloud services. So we have Needham saying that the results were softer than expected because of technical difficulty, which weighed on cloud services. And they also said that they need to improve on their outlook. Roth Capital Partners cutting the price target, as well as Cantor. Up next, we're looking at Rocket Lab. So this one is a different story because it's edging higher by as much as 10%. So the company secured defense contracts in the U.S. and in the UK. So in the U.S., the Air Force has selected Rocket Lab for a $46 billion contract. And in the UK, we have the Ministry of Defense selecting the firm for about $1.3 billion. So this just highlights the growing role that the company is playing in aerospace solutions. And lastly, we're looking at Netflix. So this one is also popping today. It's edging higher by as much as 3.5%. The company is aiming to double down on its revenue and reach a $1 trillion market capitalization by 2030. That's according to Wall Street Journal. Now it's around $400 billion, so a little more than double there, but they really have ambitious goals, and that's as we're seeing a lot of uncertainty in tariffs and macroeconomic policies, but still a lot of executives are ambitious for Netflix growth target.
All right, Isabel, thanks very much. Bloomberg's Isabel Lee there rounding up some of the stocks moving just after the opening bell. Coming up, we're going to talk more about Big Pharma prepping for new tariffs from the Trump administration. That story is next. Plus, we have a Big Pharma CFO, Joe Woke from J&J, joining us a little bit later on Open Interest.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I didn't
Ready? Go.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings stick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Well, we talked about chips, so let's take a look at pharma because the Trump administration has begun an investigation into pharmaceutical imports, which could lead to tariffs and broaden the U.S. trade war. For more on that story, we're joined now by Bloomberg's Madison Mueller. And Madison, tell us what we know so far. It was interesting to see the CFO of Johnson & Johnson tell our print colleagues that he thinks that this will mostly be really focused on cheap generics versus, maybe some of the stuff that Johnson & Johnson sells. But what do we know about the scope of this probe?
So we don't know a ton so far. I mean, they are looking into API, which is the active ingredients used in pharmaceuticals, finished drug product. We don't know what the outcome of this probe is going to be so far. The J&J CFO seemed to think there could be a silver lining, that this probe will maybe show that generics are made overseas while branded drugs are mostly made in the U.S., and that could lead to maybe lower tariffs or no tariffs at all on branded drugs. So we'll see what happens, but they have a few months. They have 270 days to complete this report. They could finish it sooner. There could be an announcement on tariffs sooner, but it could still be a couple of months before we know what the impact will be on pharma and what the potential tariffs will be.
So what percentage of the drugs we take are made in the U.S.? Like if I'm going to buy Prozac or Xanax or Vicodin, Percocet, are those
sounds
just
fun.
Like a top 10 list here? Are those made here? Are the ingredients from here?
Yeah, so pharmaceutical supply chains are super complicated, and if we take Lilly's best-selling drug Zepbound, for example, there are parts of it that are sort of made all over. So Lilly and all the other drug companies have manufacturing facilities all over the world. Lilly makes the starting ingredients, the active ingredients for Zepbound in Ireland. Then they ship it to the U.S. for a second step of API. Then they do the fill finish here. So it's kind of, these supply chains are super complicated. They've been built up over several years, decades, and it happens all over the world.
I was denied once again for Zepbound.
Unbelievable.
Oh, wow.
I tried for Wegovy. Insurance said no. I tried for Zepbound. Again, no.
Well, one thing just to kind of switch gears back to what you had mentioned before about the generics, because I think about this a lot in terms of what this means for lower income customers. Generics often help create a broader availability of a drug, do they not? So does that not create an availability issue if those are the ones that are facing issues?
Yeah, and I think that that's the concern, is that tariffs would hit generics a lot harder. Obviously, the margins are lower, and generic makers might decide, you know what, this isn't worth it. This is too expensive. We're just not going to make this product anymore. So I think that the concern, at least from the experts that I've spoken to, is that we could see drug shortages. We could see less availability of certain products. You know, they could just decide not to make it anymore. It's not worth it for them. So branded drug makers might not be hit quite as hard, but for generic drugs, which are still mostly made in China or India, there might be more of an impact.
Yeah, a lot of moving pieces there. We appreciate you staying on top of it. That is Bloomberg's Madison Muller. And keep it here on Bloomberg Open Interest. We'll be speaking with Johnson & Johnson CFO Joe Wolk in the next hour, talking about many of the topics we just discussed and their unchanged guidance. But coming up more immediately, more tariff talk. We'll focus on a possible reprieve for autos next. This is Bloomberg Open Interest.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks. About 20 minutes into the session, we're up on the S&P, 0.7%. Third day in a row for gains. The NASDAQ up 0.9%. Small caps gaining as well. If you take a look at the big stocks, NVIDIA and Apple, they're both adding points to the S&P. Not up a lot, 0.25%, 0.8%, but enough maybe to move the index. And then Boeing down on that news out of China, Tesla up, and GM down, even though you had what should be, Shanali, good news out of Canada.
We are going to dive deeper because, as we've been talking about, Canada says it will allow automakers to continue to import a certain number of U.S. assembled cars and trucks, and tariff-free, as long as they keep manufacturing vehicles in the country. Joining us now, Bloomberg auto reporter Keith Naughton in Detroit. How much, ultimately, of a reprieve does this create? You certainly are getting a pretty mixed reaction from investors.
Yeah, it's a real clever exemption from Canada because they recognize they're in this battle now with the United States for car production. So they're saying, we'll let you bring your cars into Canada tariff-free, but you have to keep building cars in Canada. And there are a few, factories out there that are sort of hanging in the balance. Ford is overhauling a factory in Oakville, Ontario, that's supposed to build pickup trucks starting next year, but that sometimes is in question. GM just shut down production of its Bright Drop electric vans in Ingersoll, Ontario. So there are things going on in Canadian car production, and they want to make sure that they still get that. And that's what these exemptions are all about.
Yeah, it's a really interesting move by Canada. Let's get specific when it comes to the different automakers and how it might impact them, because we were talking about before the break, you think about Ford, which does a lot of its manufacturing in the U.S. How does a Ford fit and fall under what we're talking about here, this move from Canada?
Yeah, so as I said, Ford is supposed to start building Super Duty pickup trucks next year in Oakville, Ontario, where they once built the Edge SUV and where they thought about building electric vehicles. There's been a lot of uncertainty around that assembly plant. Ford has another very important factory in Windsor that makes engines for its best-selling F-Series pickup trucks. That's a critical factory. And, you know, there's been great concern that those engines will face the 25% tariffs coming back on this side of the border. So Canada is important for Ford, but they're not currently producing cars there like General Motors and Stellantis is.
I wonder what kind of market it is. How important is Canada for U.S. automakers? They have a lot of car reviewers. My favorite YouTubers, the Straight Pipes, are out of Canada. I think Throttle House is out of Canada. Ryan Fort9 is out of Canada. But they're not really that many Canadians, right? And they have to pay more for their cars anyway.
It's a very small market, Matt. You're absolutely right. It's nothing like the 16 million new cars that are purchased in America each year. Pales in comparison. But it's an important production hub for automakers, including Toyota, by the way, which builds a ton of cars in Canada, and Honda. So it's important that the flow back and forth be no tariff or low tariff.
All right, Keith, really appreciate you hopping on to talk about this breaking news. Our thanks to Bloomberg's Keith Naughton joining us from Detroit. And don't miss our interview coming up with the CEO of Hyundai. That happens in about 30 minutes' time. I do want to get back to these markets right now. The S&P 500 up. It hit session highs, higher by about 0.7%, coming back a little bit right now. You can see that big tech is really leading gains today. If you look at what's moving in the S&P 500, moving us to the upside on a points basis, it's NVIDIA, it's Microsoft, it's Netflix. Johnson & Johnson is a weight to the downside. We'll be talking to the CFO in just a little bit. The Russell 2000 also managing to do a switcheroo here. It had been lower pre-market, now higher to the tune of about 0.8%. I will note once again, you guys, that volume is pretty light on a 30-day average. Relative to that, we're down 26% right now when it comes to trading volume. So clearly, again, folks just a little bit tired and waiting for the next catalyst.
Yeah, but at the same time, you see a lot of support from governments like Canada, as we've been saying, and also, frankly, the Treasury Department, between Scott Bessent coming out and talking to Anne Marie about the support that they're willing to give, his number two in Washington speaking about the support they're willing to give to the banks. And so there's a floor being created.
Yeah, and there's also the fact that a lot of times uncertainty means inactivity, right? Which may be why you see volume drying up. We'll talk to our next guest about that. David Costin joins us from Goldman Sachs. Plus, we talk to J&J's CFO, Joe Wolk, and Wendy Schiller of Brown on Harvard.
So important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having among the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. A federal judge in Maryland holds a hearing today on the Trump administration's refusal to abide by the Supreme Court's order to return a man mistakenly deported to El Salvador. Now, Maryland Senator Chris Van Hollen says he's put in an urgent request to meet with President Nayib Bukele, who is also refusing to cooperate and send Kilmar Abrego Garcia back home.
It is absolutely unjust and illegal to have this Marylander detained one more day in a notorious prison in El Salvador.
If Abrego Garcia is not returned this week, Van Hollen says he is prepared to go to El Salvador himself. Word in from the U.S. Coast Guard, 5 migrants whose boat capsized on the way from the Bahamas to Florida are all feared dead. Officials have called off their search. They say the trip was a suspected failed smuggling venture. Gene-edited pigs could be a godsend for people with sudden liver failure.
The pig producer eGenesis says the FDA has okayed a clinical trial in up to 20 severely ill patients. These would not be liver transplants. The pig organs would be temporarily attached outside the patient's bodies and filter their blood so their own livers could rest. 35,000 people in the U.S. are hospitalized each year with sudden liver failure. Many don't qualify for a liver transplant or can't get a match in time. Michael Wallace, CBS News.
Jury selection is beginning in New York today in Harvey Weinstein's Me Too retrial. CBS New York's Christina Fan.
At his first trial, Weinstein faced testimony from 6 women, 3 whose accusations formed the basis of the charges, and 3 more to lend credibility and establish a pattern of misconduct. Last April, the New York Court of Appeals ruled that those additional witnesses biased the case and, as a result, overturned that verdict.
Meta CEO Mark Zuckerberg is expected back on the stand at his historic antitrust trial. The outcome could force the tech giant to break off Instagram and WhatsApp. Tech consultant Ian Scher.
The truth is that over the last decade, Instagram has become a key part of Facebook's strategy, in particular luring younger people who otherwise may have gone to other apps like TikTok or YouTube.
Some people in and around San Diego are still picking up the pieces after yesterday morning's 5.2 earthquake. Dylan Carnero says he's dealing with hundreds of dollars worth of damage to his store.
Once I stopped hearing the bottles popping and everything, my first thought was just to get outside and onto the street and away from the buildings.
Stocks up less than 1% in early trading. This is CBS News. Did you get your taxes done yet?
Today is the deadline to file 2024 returns. The IRS began accepting them back in late January. There are extensions to May 1st in 9 states, most notably several affected by disasters, hurricanes in the Carolinas and Florida. Some IRS workers affected by sweeping federal cutbacks could learn their employment future as early as today. Food chains are offering tax day deals, 1-cent cheeseburgers at Burger King and buy one, get one free offers at a number of other places, delivery discounts too. Steve Kathan, CBS News.
The formula for the best 24 hours ever.
Just a perfect day.
After analyzing data from an American time use survey, scientists at the University of British Columbia have come up with an itinerary. It includes 6 hours of quality family time, 2 hours of exercise, and just 1 spent eating and drinking. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well. So check us out on YouTube. Just search Bloomberg Podcast Live. That's where you'll find us. Tuesday, April 15th, Tax Day. Sitting in for Alex Steele, Norma Linda. Nora, thank you so much for joining us here today.
Happy Tax Day.
Taxes all done?
They're squared away.
All right, so we got Nora sitting in for Alex. All right, this is what I've determined about Alex. She is not allowed to take any more holidays. No more vacation.
I'm jealous.
This is not working good for me. I need Alex here. So, but she'll be back soon. So coming up on the show, we're going to check in with George Ferguson, talk to him about China not buying any more Boeing aircraft. That sounds ominous. Nancy Tengler, CEO and CIO of Laffer Tengler Investments. We'll get her thoughts on the markets. Ira Jersey, Bloomberg Intelligence Senior Rate Strategist. We'll get his thoughts on where the Fed is going to go as we digest some economic data this week. And Allison Williams, Bloomberg Intelligence, she covers all the banks, and she has been busy for the last several days. We had Citi report today, B of A, so we'll get the latest on all the big banks. So a lot coming up in this hour. Let's kick it all off with Mr. John Tucker.
All right, guys, and this Bloomberg Business Flash being brought to you by IBKR. Will U.S. initial jobless claims exceed 260,000 for the week ending May 10th, 2025? Well, the yes was recently at 8%. You can trade your prediction with IBKR Forecast Trader at ibkr.com/forecast. Last trading day for this contract is May 14th. Major averages are all higher by about 0.5% or a little more. 10 of the 11 major industry groups in the S&P 500 up right now, and it's the financials that are leading the way as those bank earnings continue to indicate solid results. NVIDIA, Netflix, and Broadcom, those are the individual leaders right now in the S&P 500 in terms of index points. I had this headline cross a few minutes ago. This is interesting. The junk bond market, high yield, has reopened with the first deal in nearly 2 weeks. Meantime, Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley, says, you know what, the markets have yet to bottom out.
It takes time to heal.
And so what we're looking for is sort of a backing and filling, choppy market for the next, month or two at least. Maybe it goes further than that.
And some of the individual results, Allison, of course, is going to break these down a little further, but Bank of America shares right now 4% higher. And then you had news about Boeing. That came out earlier today, but China has ordered its airlines not to take any further deliveries. Boeing's jets, Boeing shares right now 1% lower. They just can't get a break. New York State factory activity contracting in April for a second month. A gauge of the near-term outlook for business conditions plunging to the lowest level since 2001. And right now, the S&P 500, 34 points higher. Dow Jones Industrial Average up 192. The NASDAQ 100 up 171 points. What's the world's best performing stock market this year? Anybody? Anybody?
Not the U.S.
In dollar terms.
Okay.
Ghana up 17%.
Wow.
So there you go.
The more you know.
Put that in your pipe and smoke
For this
it.
Tuesday morning.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and hi, Nora.
Hello.
John Tucker, thank you so much. We appreciate that. Nora Melinda sitting in for Alex Steele today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio, and we're streaming live on YouTube as well. So go over to YouTube and check us out there. Market Drivers today is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. As John was just reporting, got a little bit of green on the screen here today. We'll take that. We'll see if it holds. Let's see where the action is under the hood. We go to Isabel Lee, Bloomberg's cross-asset reporter. She joins us here in our studio. Isabel, what are you looking at?
Applied Digital. It's edging lower by more than 20%. It's just really sinking to sessions lows, the lowest in September. If I'm eyeballing it
there you go.
correctly. So the company reported third quarter results that missed estimates both on revenue and adjusted EBITDA. So Applied Digital is a company that builds and operates big, powerful data centers. They support things like artificial intelligence and cloud services. And Needham says that the results were softer than expected. They said there's a technical difficulty and it weighed on the cloud services segment. We have Roth Capital Partners cutting the price target to $8.50. We have Cantor also cutting to $7. For now, though, the stock is hovering around $4 and 0.25 cents. So still far from those price targets that they've cut.
Right. What else are you keeping an eye on in space?
Rocket Lab. So it's edging higher by around 7%. So the company secured defense contracts with both the U.S. and the UK. Oh, now it's up even higher by around 13%. So in the U.S., the Air Force has selected Rocket Lab for some $46 billion contract, and it really highlights the growing role of the company in providing advanced aerospace when it comes to like national defense, which is important. And in the UK, we have the Ministry of Defense selecting the firm for around $1.3 billion. So that's a double whammy and a double win for Rocket Lab today.
How about Netflix?
This is exciting because the company had big, ambitious goals. They said they're aiming to double their revenue and reach a $1 trillion market capitalization by 2030. They're now hovering at around $400 billion, so a little more than double. And these are ambitious goals, but it really just shows the confidence that they have and the heft as the largest global streamer. We have BMO Capital Markets saying these are ambitious goals, but they're achievable. And we have Jefferies saying that they're proving resilient against a tougher macro. Because remember, we're living in a really uncertain environment with all the tariffs. And if you come out with this really big optimistic goal, that's something.
That is something. All right, Isabel Lee, thank you so much. We appreciate that. Isabel Lee, cross-asset reporter for Bloomberg News. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcast. One of the big news items out there today is China over the last 24 hours, let's say. China saying, we're not going to buy any more Boeing jets. So just another escalation in the trade war between the U.S. and Canada. I'm looking at the Boeing stock today. It's off about 0.9%. George Ferguson joins us. He's senior aerospace, defense, and airlines analyst for Bloomberg Intelligence. George, talk to us about China and Boeing. How big of an issue is this for Boeing?
So I don't see it as being a big issue, right? So this is one of those things that the relationship has deteriorated over a period of time. We're basically writing right now a focus idea on Boeing that we'll publish in the Bloomberg Terminal. And as we're doing that research, right, we took another look at when we saw orders from the Chinese airlines for Boeing. And there's been like 15 or 16 this decade I think 15 came in, I think, last year, of 242 orders from China that are on the books right now. The last real material size in orders from the big Chinese airlines we saw back in 2018. So this is a relationship that's been broken for a while. Frankly, the Chinese haven't really been, like I said, ordering from Boeing. So the bigger issue here, I think, is Boeing delivering some of the airplanes they've already built for the Chinese. Like I said, there's some 240 of them sitting in the order books. I suspect a bunch of them are already made, and Boeing would like to get rid of them. Part of the shadow factory elimination they're trying to do to streamline operations. It's a pain in the neck to have an airplane on the tarmac that's sold that you've got to maintain, but the customer isn't taking delivery of. It'll slow that down. I think it might hasten some of Boeing's push to sell some of those airplanes. The Indians have bought a bunch of them. Maybe they're game for more. But I just don't. This is China admitting what they've already been doing, frankly.
So, George, what exactly is the goal here? I mean, to your point, and also Jefferies analysts, they're noting that Boeing has largely de-risked from China. They said that the country contributing roughly about 5% of the skyline over the next couple of years, but also a source of upside. What do you think the goal is here if there seems to be marginal impact here to Boeing?
Yeah, look, I think it's splashy, right, for the Chinese to make this kind of commentary. And look, I do think there's potentially some upside. So, look, there's a couple things that's been going on, right? China, one, is growing a lot slower since the pandemic. Prior to the pandemic, China would take in 300 narrow bodies a year. More than half of them would be Boeing. And so, since the pandemic last year, we saw about 150 deliveries of narrow bodies into China. They were Airbus airplanes. So, and look, in a global trade battle, China could see a diminishing GDP, right? This is a country growing 8% last decade, 4-ish% this decade. But if they get that, if they decide they're going to negotiate with the U.S., they get some of that growth back on the rails. I think inside some of that negotiation, you could see a requirement to order Boeing airplanes. Donald Trump cut a similar deal in his last administration. So there is some silver lining. And like I said, I think the Chinese sort of, they know that Boeing's one of our biggest exporters. They know they'll get some good headlines out of saying we're not going to take any more Boeing airplanes. But again, I think this is a microcosm of the U.S. economy getting uncoupled from China right now.
So this isn't a major headwind here for Boeing, but what do you think are some headwinds that they could be facing? What are some near-term hurdles?
I think Boeing has been down for so long that I think most of the hurdles are clearing, and you're going to see a pretty good year. I think the big issue this year is they've really got to get Spirit Aerosystems bought and integrated into Boeing. I think that's well underway. I'm hearing good news from people I know in the industry about quality coming out of Spirit. They've got to get rid of that shadow factory. There's airplanes already built sitting on the tarmac that they're maintaining. That's just a huge drag on expenses. They got to get them delivered out to customers, sold off to new customers, and it's all about, in the back half of the year, building more airplanes in the factory. We've been watching it in the first quarter of the year. I think they're getting about 20, 25 through the factory every month. They got to keep building on that cadence. That's going to generate the cash and the profitability they need. And oh, by the way, they added $26 billion to inventory since, I think, 2018. We have it in this report. It's some 500 equivalent to 500 737s. As they start building from the inventory on hand, their cash generation is going to be supercharged. They could have a really nice back half of 2025.
George Ferguson, thanks so much for joining us. Always appreciate getting a couple minutes of your time. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst at Bloomberg Intelligence, covers all the aerospace companies and all the airlines. He sees it from the entire 360-degree picture, that whole global aerospace business. Again, Boeing, China coming out saying they're not going to buy any more Boeing planes, at least for the near term. But as George is pointing out, not that big of a deal for Boeing. They've already kind of de-risked or walked away from that relationship over the last 10 years or so. That being said, Boeing stock down 1% today. It's down 11% year to date. So again, some more opportunity for perhaps Boeing in other markets. We'll see how that plays out. S&P 500 up 27 points. That's 0.5%. NASDAQ's up 85%, so keep an eye on that. The red headline crossing the Bloomberg terminal. The EU expects U.S. tariffs to remain as talks make little progress. We'll have more coming up. Listen.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg News with this Bloomberg Business Flash. And the solid results that we saw from the banks, such as Bank of America and Citigroup this morning, they were helping lift stocks, but that lift has pretty much faded. We turned kind of mixed after that headline. Paul, you read it. The European Union saying talks are making little progress on the trade war. Bank of America stock traders, they posted a record quarter. Citigroup inched closer to a key profitability target. Right now, Bank of America shares, they're up about 3.5%. The New York Fed says its regional factory index signaling contraction for the third time this year. Also, the near-term outlook for business conditions plunging to the lowest in almost a quarter century this month. Right now, the S&P 500 back up 19 points right now, 0.4%. at 54.24. The Dow Jones Industrial Average back up 98 points. That is up 0.25%. A lot of volatility. NASDAQ 100 right now back up 84 points. That is up right now 0.5%. As far as Treasuries, 2-year yield down a basis point, 383. The 10-year yield, 2 basis points lower. That is at 435. Oh, here's one for you. Movie and TV filming in the greater Los Angeles area, just getting these figures, declined 22% the first quarter.
Wow.
Reflects a worldwide slump in production and California's continued loss of business to other areas. This is part of the broader slump. The wildfires earlier this year that devastated parts of Los Angeles actually only had a temporary effect. This is based on the film permits that were issued. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Norm Paul.
I still see lots of film sites here in the city, you know.
When you're walking down.
Yeah.
Right.
Yeah, and you never know where they're going to be. But
And of course, we have to mention the Jersey Shore. Netflix opening a location at the former Fort Monmouth.
And that is a monster facility there.
Oh, it's huge.
Yeah.
That's where my dad served.
Oh, is that right?
The Korean War.
Okay, awesome. Yeah, Fort Monmouth, right on the Jersey Shore. Good stuff. John Tucker, thank you for that. We appreciate it. Norm and Linda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube. You can head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. Let's go to professional here. Nancy Tengler, CEO and Chief Investment Officer at Laffer Tengler Investments. Zoom from one of my favorite places in the world, Scottsdale, Arizona, the Royal Palms Hotel. They love me there. Nancy, talk to us about what you've been doing over the last, and your team over the last 4, 5, 6, 7 weeks here as this market's trying to adapt to some differing policies coming out of Washington.
Paul, thanks for having me. I'll just tell you, I'm Zooming from my home. It's a far cry from the Royal Palms, but nice nonetheless. Yeah, so we have been adding selectively to names, really trying to balance and barbell sort of names that we feel would do well in a slowing environment, and then names that bring more risk to the portfolio, because that's really what you need to do after you've experienced a sell-off. And so we added two names like Netflix and Spotify. Those are kind of our recession plays, if you will, because they're sort of the last thing to go. But we've also added to some of the tech names. So think Palantir, CrowdStrike. We also added, to Microsoft and NVIDIA recently. Tesla, Ateens. So we're just trying to navigate an impossible situation. And right now, as of the last few days, we're just doing nothing. And sometimes nothing is the right thing to do in the equity markets. On the bond side, we were short on the muni market duration under a year, but using callables. Now we've begun extending duration. The muni market was kind of a mess last week, and so we worked around that and picked up some longer paper. And other than that, we're doing what everybody else is doing, not sleeping and reading the headlines.
So, Nancy, I mean, we had a lot of firms just last week. They were coming out with these recession forecasts and then ultimately walking them back. I understand that your firm has always kind of thought about growth decelerating, but not necessarily a recession. How are you thinking about equities more broadly and more in particular tech companies and what that looks like moving forward?
Great question, Nora. So, yeah, I think you're hearing a lot of people come out and say, you want to shift to Europe or you want to shift globally. Also, you want to buy value stocks. And the reason I'm a value investor by trade. So I'm always biased in that direction. But in a decelerating economic environment and earnings environment, you want to own the reliable growers. And that proved to be true in 2022. You just had to, everything sold off, and then those stocks recovered first. Now, yes, there was ChatGPT, but also fortress balance sheets that make this a very different period in some ways, though we've drawn an analogy to the 1990s. In some ways, these companies are much stronger, more levers to pull. So I still think there's a lot of room to run in the AI trade, and that's why we've been focusing our purchases in that direction. I don't have a crystal ball. We didn't think we were going into recession. I thought it was a little humorous. Remember, strategists, they want to be ahead of the headlines. We have a track record that people can see and touch. So I'm trying to do what's right for the portfolio for the next couple of years. And I still think you want to own technology and you want to own the larger names as well as some of the emerging names as a hedge against slowing earnings and a slowing economy.
Nancy, you mentioned adding to Tesla. Boy, you have to have a strong internal fortitude for the volatility associated with that name. How do you think about Tesla? How much is Elon Musk a factor in your investment decision?
Yeah, I mean, I love the guy because he's a visionary. I take all the, other things out of it. He has time and time again proven that he understands where we're going. But if you look at Tesla, the stock, since the IPO, I can't remember the number off the top of my head, but it's researchable. You can use Grok and ask it how much has Tesla stock gone up. But it's been in a bear market almost 50% of that time, despite remarkable total return. So we don't put it in our 12 best ideas portfolio, though we think the technology, the AI aspect of the company, the battery storage for green energy side is compelling, but it's too volatile. So when it appreciates, we trim it back, and when it sells off, and we were adding to it a little bit below current levels, it went lower. That's the way the stock trades. We added to it. We'll continue to do that going forward.
Nancy, in about 20 seconds or less, how are you thinking about small to mid cap stocks right now?
Yeah, we love the mid-cap space. I've not ever seen a sustainable period of outperformance minus the early 2000s for small cap in my career. So we're looking more towards mid-caps, and we've launched a strategy in our firm.
Nancy, thank you so much for joining us. We always appreciate getting a few minutes of your time from lovely Scottsdale, Arizona. Nancy Tengler is the CEO and Chief Investment Officer at Laffer Tengler Investments here. Looking at the Treasury market, again, last week, a tremendous amount of volatility. It's being reported that the volatility, particularly in the 10-year, was a contributing factor to President Trump modifying some of his tariff policies. So I think a lot more people are probably paying attention to the bond market than they were even recently. So let's check in with Ira Jersey, because he does this stuff for a living. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Ira, what's the bond market telling you these days?
Well, the bond market volatility luckily has ebbed the last couple of days, so it's we can now take an assessment of what was going on last week with all the extreme volatility. But number one is the market clearly has some fragilities in it in terms of liquidity, and I think that's in part driven by just the sheer size of the market. Number one, and number two, we think, and I spoke to a couple of international investors over the weekend. And they're skeptical about investing in the U.S. And if that's the case, then you can wind up, or at least adding more money to the U.S. So I think a lot of last week, it wasn't necessarily foreign selling of a lot of debt, but it was more like everyone just sitting on their hands and not buying more. And foreign private investors, particularly pension funds and insurance companies, they tend to buy a lot of longer-term U.S. debt, both in the corporate sector and as well as treasuries. So when they back off, you wind up seeing these massive spikes in volatility, and certainly you saw the steepening last week that I think was endemic of just this lack of demand for long duration assets.
Ira, earlier this month, Treasury Secretary Scott Bessent indicated that the federal government is at risk of running out of room to make good on all of its payment obligations on time as soon as May or June. What does that mean in terms of the impact on the bond market?
Oh, the debt limit is so annoying. I've said this before, it's the dumbest debate Congress has. At the end of the day, you're talking about the full faith and credit of the United States government. Don't fool around with it. And in terms of trying to get the deficits down, everyone thinks, oh, if you don't raise the debt limit, then that means that the deficit has to go to zero. That's true at some level, but it also means that you run out of money to pay people, someone, right? Whether it's a debt holder or some employees or a contractor or whatever. So I think, that for the bond market itself, it usually means very little. And the reason is because everyone knows that they're eventually going to raise the debt limit. what it affects are the T-bills right around that so-called X date, right? So now it's interesting, you know, I think the Treasury Secretary hopes that Congress raises it earlier, but most of our work suggests that actually that there should be enough room to get to June 15th. If you get to June 15th, there's another tax date. So today's a tax date, get another one in June, and then there's more extraordinary measures. So there's accounting gimmicks that they use for it that kick in on June 30th. So so our date is right around August 1st. We'll have a better idea in a couple of days when we find out exactly what the Treasury's cash balance is after the tax season. So basically today and tomorrow when all those tax checks are deposited. So look for those T-bills, right? So that's where you want to look. So right now, you know, where are the early June T-bills trading versus other T-bills around it? That'll give you a better indication about if the market's really thinking that that's the X date.
All right, what's the soccer match I need to pay attention to over the coming days?
Oh, it's this afternoon. Aston Villa versus PSG at Villa Park in Birmingham, England for the Champions League. Villa's down by 2 goals right now, but you know that I'm very hopeful. Fingers crossed that maybe Villa could pull it back. We've been scoring a lot of goals, so we just have to break down PSG. And in fairness, PSG has been the class of Europe so far this year. It'll be a tough road, but certainly something to watch.
All right, Ira Jersey, there you go, Chief U.S. Interest Rate Strategist and a Aston Villa fan to the max, that's for sure. Ira Jersey, he's there with Bloomberg Intelligence down there in Princeton, but we know what he'll be doing this afternoon. What have you been working on, Nora?
What haven't I been working on?
Exactly.
Is the
Your
question.
markets team, I mean, you're just cranking it out. You can't take a wink of sleep.
We can't stop. I mean, my eyes have been everywhere. I cover real estate stocks as well as aerospace and defense more recently. But I've honestly been looking at Fannie and Freddie. That's been an evolving story that I've kind of been digging into more recently, just trying to see what's going to go on in terms of people expecting some sort of privatization.
And is that a probability, a likelihood?
It really depends on who you ask. I mean, you ask Bill Ackman, he has a bold case for it. You ask some other people on the other side of the aisle, and it seems that if it is something, it'll be late in Donald Trump's term.
All right. We'll keep an eye on that, Fannie and Freddie. I haven't really thought too much about those entities since the great financial crisis. The market's holding on to some gains here. We got the S&P up 20 points. That's 0.3%. The Nasdaq's up 46 points. That's about 0.3% as well. 10-year Treasury yields 4.35%. We'll have more coming up. This.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. You have 9 of the 11 major industry groups in the S&P 500 higher right now. The financials in the lead after the bank earnings. Somebody likes volatility. Bank of America stock traders posting a record quarter with revenue from equity trading rising 17%. Those shares right now, Bank of America up 3.6%. We had this headline earlier, the European Union and U.S. making little progress in bridging the trade differences, with the U.S. officials indicating most U.S. tariffs on the EU will not be removed. That paired some of the earlier gains. The S&P 500, 10 points higher right now. That's up 0.2%, 54.17 on the index. The Dow Jones Industrial Average up 37 points. NASDAQ 100 is 70 points higher right now. Urian Timmer at Fidelity Management, spoke to him earlier today, says a familiar pattern emerged in the S&P 500 as it sold off last week.
If something does end up getting worse, it falls to 20%. And at that point, it's discounted a fair amount of bad news. And then you get the inevitable rally like we saw last week.
Elliott Management has built a large position worth over $1.5 billion in Hewlett-Packard Enterprise. Right now, HPE shares, they are up 5%. Hertz is telling customers that it had a data breach. It involves driver's license numbers and other personal information following a hack in the supply chain. Company sent a posting on its website. It completed an analysis of the incident. Happened April 2nd, determined the affected information may include names, credit card data, driver's license information, and details related to workers' compensation claims. Oh, great. We check the market for you all day long right here on Bloomberg Radio. I'm John Tucker. It's your Bloomberg Business Flash. Norm Paul.
All right, John Tucker, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We're live here at Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over there and check us out. Bank of America reported today. Citibank reported today. I worked for both of those firms back in the day. Merrill Lynch, which is now part of Bank of America, and Salomon Brothers, which is now part of Citi. So I always pay attention to these two names. Both trading up here today, so that's the good news. So let's get Allison Williams in here. She'll tell us the details here. She's a senior analyst. She covers all the banks for Bloomberg Intelligence. She's been working super hard this last 4 or 5 days as all these big banks put out their numbers. Allison, when I think of B of A and I think of Citi, I think of the corporate investment banks making loans for big global corporations and that kind of stuff, as well as going down to the local branch level. What are they telling us today?
So on the capital markets side of things, so your friends, the traders and bankers, really good quarter for trading across the board. We've had sort of everyone come in. Equities trading better. Citi did a little bit better in FICC and banking, so that was a key positive. But generally, we're seeing strength in trading that's helped by volatility and fees stalling, so which we know kind of is a pause. So that's broadly across the banks. The other thing is, Q1 was good, but of course we have not seen the impact of the last couple of weeks. But banks are preparing for that in perhaps different ways. Bank of America kept their net interest income guidance stable, but the positive thing there is that they are factoring in the 4 interest rate cuts. So they're factoring in what we've seen in April. So I think that is generally helpful to the shares. You're seeing them respond today. Also on the credit provision, Bank of America always provides these extra slides. As you talked about, there's all different types of businesses. There's concern certainly on the consumer business, tends to be a higher loss in Bank of America, showing a slide the shift in their portfolio over the long term, but also making the point that, look, they're reserved at about a 6% unemployment rate. That's similar to what we heard from Citi. I'm sorry, that's similar to what we heard from JP Morgan and Wells. We're going to hear more from Citi on their call in a bit. But their losses tend to be lower. This, responsible growth is something that Moynihan has championed. Some have been critical when things are better. Are you taking enough risk? But in a period like today, when we're worrying about risk, I think that gives some cushion.
Allison, so up today, we're seeing shares up today. But if you look year to date, we've got Bank of America down 14%, Citigroup down 8%. Broader financials down about 1.5%. But that being said, what do you think has really been the drag for them as of late? Because, I mean, this sounds like pretty decent news, but, on a broader scale, that's not necessarily the case.
So I think that what we saw was a big rally in these shares after the election. People were very excited about less regulation under the new administration, and we saw evidence of that this quarter in terms of buybacks. Buybacks were bigger than expected for everybody except for Morgan Stanley, a huge announcement by Goldman Sachs. And so capital return, being able to return more capital, is one of the positive benefits that is coming through. So we had the big rally on less regulation. M&A being helped by less regulation was part of that. We did get the buybacks. M&A is not coming through because there's so much uncertainty in the environment. That goes to some of the comments we heard earlier, just in terms of, pipelines, are they broken or bent? So I do think it does depend. Like, if we can get things, changing course, if we get some level of certainty, that can improve. But if there is more volatility, perhaps not. And it really comes down to the economy. So if there is a weaker economy, if there is a recession, not good for financials.
So Citigroup in particular, Jane Fraser, she's about a little over halfway through this 5-year plan for a turnaround for the bank. How's that going? Are people liking what she's doing?
I think people are. She's making progress. So we saw some of that this quarter. It's certainly a very long-term story, and a lot of that has to do with, to some extent, when you're fixing things that the regulators want you to fix, that can take some time, and it's not fully within your control. I mean, it's within your control to deliver on things, but it's a negotiation, and you have to, sort of meet those standards. As we've seen at Wells Fargo, that can take a seriously long time. But I do think for Citigroup, it's the best thing that could have happened to them, because really, the Citigroup is the house that Sandy built and has all these different businesses. And I think finally taking the steps to rationalize and integrate things and improve the risk management systems are a good thing in the long term, even though there's some pain near term.
Brian Moynihan of B of A on the conference call this morning, did he acknowledge the uncertainty and the decline in consumer sentiment just in the last several weeks, and corporate sentiment as well? We've seen polling on that. You look at the University of Michigan data, people were concerned about things. Did he acknowledge that and just maybe think about how that might impact their business?
He did talk about sort of the pivot since quarter end. He talked about that, especially with regard to the reserve build. So again, I think that's one of the things that we're seeing a little bit different at banks. JP Morgan taking a big reserve. Of course, they had a gain that helped to fund that. Wells doing very little, but they were already pretty well conserved. And Bank of America saying, look, we do our reserve at the end of March, but then there are different factors. We can use judgmental factors and different factors to sort of shore up that reserve a little bit. And so even though the headline numbers don't look like, they're taking big reserves, their credit is good. The charge-offs are good. And so the fact that, even just kind of keeping those reserves stable, when your credit is improving, shows a level of conservatism.
So big bank earnings kicked off on Friday. We're sitting here Tuesday. You've gotten so many names that you're kind of parsing through right now. But of course, to your point, this is a really uncertain period. So what is a general expectation? Do we expect that investors are going to punish companies harshly if they were to miss? Or does it seem like people are kind of just going along with the flow and seeing what's going to happen given the tumultuous time period?
I think it's, for investors, like so many other stocks out there, right, there's a level of uncertainty. And I do think that, as you said, that so the stocks have come way down. They're factoring in a level of risk. But investors have to feel more comfortable that they have a handle on those risks or clarity. So that could stop people from getting involved. But in terms of, it depends on what happens from here. Do things get worse? Or the risk of recession rise? You could see bigger provisions in the second quarter. And so investors were wondering, will we see banks being conservative? And I think what we saw was banks really saying, like, look, we're going to wait and see.
Okay.
As of March, things are good. We recognize that things are getting a little weaker, but we're going to wait and see.
Allison, thank you so much. As always, appreciate it. Allison Williams, senior analyst covering all the global banks for Bloomberg Intelligence. Citi, Bank of America today. Both stocks up 2, 3, 4%. So some positive results there from this week. We'll have more coming up. This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, we got Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in a Bloomberg Interactive Brokers studio, streaming live on YouTube as well. One stock that's really taking it on the chin today is LVMH, the luxury retailer, down 7.6%. Some results here a little bit concerning. The company calls out weaker demand from China. The United States, the sentiment change just over the last several weeks has been weighing on their outlook. Deb Aiken joins us here. She's a luxury goods analyst for Bloomberg Intelligence. She is based in London. She knows these luxury companies really, really well. She's our go-to voice. Deb, what did you take away from LVMH today? What are they seeing in their business, the business of luxury?
Hi. So fashion and leather goods is 50% of their sales. So actually, this is a Q1 organic sales growth figure only, not the earnings. And we saw with fashion and leather, it was down 5%. The market had expected down 0.5%. And what we saw behind that, the US is holding up okay, so's Europe. But where they did a big chunk of their business last year from tourism shifting across from China to Japan, that's now dried up against 2 years of big numbers. And the big thing is that it hasn't repatriated back to the mainland. So that was one side. Another side for them would be, if we think about the wines and spirits division, which houses their cognacs, that's still very tough in the US and also in China. And then Sephora was a big growth driver last year for them in the US. That's kind of fallen away a little bit on the big comps.
Mm-hmm. So, of course, we know weakness in sales in China has really been an overhang for LVMH and just the broader luxury industry. But also we had that headline earlier saying that the EU expects U.S. tariffs to remain as talks make little progress. So that being said, how are a lot of these luxury companies really thinking about this tariff environment and the uncertainty there as it thinks about the U.S. consumer?
Right, so we tried to get some of this, LVMH was the first to report, and we tried to get a real feel of that on the call yesterday, and that didn't come. We've done certainly a lot of our own work on Excel, dug deep, gone through all of the different factors. And we can see, when we look at these companies, a range of maybe 2 to 8% in terms of need and price rise. So the highest end companies have the biggest margin. So therefore costs are lower, and generally they're operating out of Europe. And so that means that they would need to price probably low to mid single digit to cover that, given that currently across Europe we have a 10% tariff risk hike. Of course, that could change. But, it's going to be difficult because the last 3 years we've seen price hikes of 25%. So since we've had a pandemic recovery, so they really are running off a very high base on the pricing. They're going to have to really determine what they do in terms of more manufacturing over there where they can. So for mid-range, for some of LVMH's fashion and leather goods, we think around a third of their US is covered in terms of US sales versus production, but there's a long way to go. And it can't be done quickly because you need really good artisans and to be training in labor. And that's one of the biggest issues for these companies.
I'm looking at the PGEO function on the Bloomberg terminal, and I see that Asia, excluding Japan, makes up about 27% of LVMH's business. So it's material. What are they saying about China? Is this a market that they can depend upon being a growth driver going forward or not? Because I know just from reading your work and talking to you in the past, China's really the linchpin for global luxury.
Yeah, I mean, the big thing and the big hit over the last quarter really in these share prices has been that the second half of last year, we saw the US really start to improve, and that was offering a bit of a lifeline until we could start to see China, hopefully by the second half this year, improve that, or that changes, the mindset changes, the consumer sentiment changes. And so, yes, for the long term, there's still a lot to do for all these companies, and each of them will say they still pin their hopes on China for the long term, more infrastructure into the marketplace, owning the consumer more over there. But certainly in the short term and in the year ahead, there's so much uncertainty. And I really think that hits hard on consumer sentiment, not only in the US, but also and particularly in China. Another one we saw today was Beiersdorf with Nivea, and the very high-end La Prairie came out. And I'm just trying to get a feel of how beauty is doing over there. And the view there is that they've had to clean up China even more on the La Prairie brand, which is very high-end skincare. And they're having to actually also think about Nivea and rebranding it to at least the premium level, so there's more price volatility in the market, and that's already starting to creep up in China.
All right, Deb, thank you so much for joining us. Deb Aiken, she's a luxury goods analyst at Bloomberg Intelligence. She's based in London. So just looking at some of the business lines here for LVMH, wines and spirits, champagne and wines, cognacs, fashion, leather goods are kind of all over the place. Perfumes and cosmetics. They're in so many different businesses, but I guess it all goes to the, to the luxury side of the business.
For sure. And you know what's really interesting? I was looking at the fact that, so LVMH actually wanted to purchase Hermes about 15 years ago, but now we're seeing Hermes, they have their market cap surpassing their rival LVMH.
Okay, very
really
good.
Interesting.
So we'll see. Luxury goods. Deb Aiken here with us. We appreciate that. The market here now it's a little bit higher, but it's holding on to its gains, and that's a good thing. All right, so. Our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the best market news and industry research. The next hour of Bloomberg Intelligence starts right now with the S&P 500 up 20 points, 0.4%. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, Woo Jin Ho, Bloomberg Intelligence Senior Technology Analyst. He's going to talk about HPE, one of his tech names. Elliott Investors is set to take about a $1.5 billion stake in HP Enterprises. So we'll see what that means for that company. Janet Lauren, Bloomberg higher education reporter on Harvard, hit with a $2.2 billion freeze after defying President Trump. Gaurav Malik, Chief Investment Officer, Palace Capital Advisors, get his market call. And then we're going to play back some tape from yesterday. U.S. Treasury Secretary Scott Bessent speaks with Bloomberg anchor Anne-Marie Horton yesterday about a whole host of wide-ranging economic discussions. So we'll bring that to you as well. Right now, let's go to Amy Marsh and get a Bloomberg Business Flash. Amy.
All right, thank you, Paul. A group of banks led by J.P. Morgan Chase & Company and Citigroup will be using their own balance sheets to fund roughly $2.2 billion in debt to support car parts maker Apollo, that just crossing the Bloomberg terminal. Citigroup stock is 2% higher after it posted first quarter earnings of $1.96 a share, better than Wall Street estimates of $1.85, inching closer to a key profitability target in the first quarter. Chief Executive Officer Jane Fraser has reorganized the bank, hired leaders from outside the firm, and cut thousands of roles. Despite hopes for de-escalation, investor nervousness about the trade war remains, with a Bank of America survey showing sentiment toward the economy the most negative in 3 decades. And we do check markets for you all day long here at Bloomberg. The S&P 500 up 0.4%, NASDAQ up 0.4%, the Dow up 0.3%, the 10-year Treasury yield at 4.34%, and the 2-year yield at 3.82%. Mike Wilson is Chief U.S. Equity Strategist at Morgan Stanley, and he says markets haven't bottomed out yet.
It takes time to heal. And so what we're looking for is sort of a backing and filling, choppy market for the next, month or two at least. Maybe it goes further than that.
Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. Healthcare giant Johnson & Johnson posted better than expected first quarter earnings and revenue, boosting its full-year sales outlook to reflect the acquisition of drug developer Intracellular Therapies. Johnson & Johnson shares now about 1% lower. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That is a Bloomberg Business Flash. Let's go to Bloomberg Intelligence with Paul Sweeney and Nora Melinda.
Push that blue button. Amy Mars, thank you so much. We appreciate that. We have Nora Melinda sitting in for Alex Steele. I'm Paul Sweeney. We're live in a Bloomberg Interactive Broker studio in New York City. We're streaming live on that internet thing, so go to Bloomberg. Actually, go to youtube.com and then search Bloomberg Podcast Live, and that's where you'll find us. You know, Amy had that story about banks to fund $2.2 billion of debt for Apollo Auto Parts, LBO. Why is that news? Because the banks have been competing against private credit. And the private credit folks have been doing bigger and bigger deals that were exclusively really the realm of the big commercial banks like Bank of America and J.P. Morgan Chase. But
interesting.
So it's interesting to see that and you know who wins on that is the issuer, because now not only do they have different banks competing against themselves for the business, but now they've got private credit competing. So I think that will result in better terms for the borrower. So that's an interesting thing.
Big headline.
The bank stepping up here for that deal. Let's take a look at these markets here. We still got a little bit of green on the screen here. Isabel Lee joins us, cross-asset reporter for Bloomberg News. She joins us here in our Bloomberg Interactive Broker studio. Isabel, what are you looking at?
We're looking at Netflix, and we're going to continue with the green. It's edging higher by almost 5.5%. So the company basically aims to double its revenue and reach a $1 trillion market cap. That's according to Wall Street Journal. And Netflix now has a market cap of around $400 billion. So it's definitely an ambitious goal, but we had BMO Capital saying it's achievable given their best-in-class leadership team. We have Jeffrey saying that Netflix is proving resilient against all the tougher macro. I mean, we know that it's really been a tough environment for markets right now with all the uncertainty with the economy and trade tariffs. But still, it just really highlights that the executives are optimistic about the country's growth.
Big numbers, huge numbers we're
really
talking about.
$1
I'm not sure what the drivers are that get you there. Subscribers, advertising. I'm not sure how that plays out.
Big number.
Good for them. The stock's been phenomenal. What else you got?
Bank of America. So this is also edging higher by around 4%. So we have stock traders posting a record quarter, and that's as the company reaped the benefits of the volatile markets. We heard the same with other big banks like Goldman Sachs. So we have revenue from equity trading rising 17%, and that's how Bank of America beat estimates per earnings per share. And trading of fixed income, currencies, and commodities also came in close to expectations. And the bank sales and trading unit delivered its 12th consecutive quarter of year-over-year revenue growth. So really, it's the kickoff for the earnings season has been a good start, and we have really the banks to thank for it.
It seems like people are really liking these earnings, especially we see financials being the best performing sector right now in the S&P 500. You've also got eyes on Boeing.
Boeing, so this is the opposite story. Shares are edging lower by around 1.5%. So China basically ordered all of its airlines to not take any further deliveries of Boeing jets. And this is part of the tit-for-tat trade that we've been seeing being drawn out the past weeks. Beijing also asked the Chinese carriers stop any purchase of aircraft-related equipment and any parts from U.S. companies. And these tariffs on their own would have more than doubled the cost of U.S.-made aircraft and parts, which is why, to some, it's impractical for Chinese airlines to accept Boeing planes. For Boeing, obviously, this is really not good news because it's a fresh setback. I mean, China is the world's biggest market for aircraft sales, so that's a big market that's shut out for them.
Very good. We appreciate that. Isabel Lee, cross-asset reporter for Bloomberg News. One of the names in the news today is HP, Hewlett-Packard Enterprises. Stock's up 5% here. We got Elliott Management said they've taken over a $1.5 billion stake in HP Enterprises. Let's break that down, what it means for the company in the space. Woo Jin Ho, senior technology analyst. He's over there at Bloomberg Intelligence down there at our Princeton offices. Wooj, what's this investment by Elliott Management in HP Enterprises? What's that all about?
Yeah, hey, Paul. So it looks like Elliott is looking for an opportunity here to create a stake in terms of possibly extracting more cost actions from HPE, especially when the company is going through a down period from an execution standpoint, as well from a demand perspective as well.
It's interesting. When you look at HPE, you look at the stock, year to date, we're sitting here in mid-April, and it's down 30%. So what exactly are they really wanting to do here through this investment as an activist investor? What do they want to change?
Yeah, that's a good question, Nora. I mean, look, there were no official statements from Elliott, nor a pretty slide deck that typical activist investors do. But one of the things that I think they're doing is trying to extract more cost actions. One of the things that HPE did after their execution fumble last quarter was cut costs, right? They cut about 2,500 to 3,000 people. That's the plan over the next 12 to 18 months. That's supposed to lower the cost structure by about 500 basis points to have OPEX to sales from 24% to about 19% for the year. Now, the closest comp would be Dell, and Dell is running around 15% OPEX to sales. So I think, Elliott is trying to look for a little bit more than 19% OPEX to sales to drive up the earnings going forward.
So is this just a cost story from Elliott's perspective, or is there something Hewlett should be doing they're not doing from a revenue perspective?
Yeah, from a revenue perspective, I mean, if we turn back to last quarter, there was a really big execution faux pas in terms of they mispriced their servers, and if you're an investor, I mean, how does a company misprice servers to really screw up the rest of the year from a pricing standpoint and from a margin standpoint? So, I wouldn't be surprised if Elliott is looking for a management change as well, because Hewlett Packard has lagged what Dell has done from an AI server perspective, they really haven't gained material share on the networking side nor on the storage side against some of their closest comps.
Well, Elliott has a really successful track record, from Salesforce to Cistrix Systems, a few others. How are people really receiving this right now? Are investors happy?
Well, I mean, 5% stock boost off the print seems like a positive sign. I think, some of the calls that I've received initially off the print, Nora, was is the Juniper deal off the table as a result? I don't think so. The one thing I will add was that Elliott was a stakeholder of Juniper multiple years back, and they did extract more dividends from Juniper as part of being a stakeholder. They may, I wouldn't be surprised if Elliott wants a board seat to guide the management going forward. But I do think that the HPE Juniper deal is still going to be on track.
I mean, HPE's got a $20 billion market cap, so $1.5 billion is a big slug there. So that might buy them a board seat. Woo Jin Ho, thank you so much for joining us. We really appreciate it. Woo is a senior technology analyst, Bloomberg Intelligence, one of our really good tech folks we have all around the world covering the global technology space. He's based down there in Princeton, New Jersey. One of the big stories that's getting a ton of readership on the Bloomberg terminal is Harvard has hit with financial retribution after rebuffing Trump. So Harvard University President Alan Garber rejected the Trump administration's demands to combat anti-Semitism, citing concerns over academic freedom and government interference in higher education. Let's break this story down with Janet Lauren. She's a higher education finance reporter for Bloomberg News. She joins us here in our Bloomberg Interactive Broker studio. Janet, Harvard seems to be one of the few institutions or entities openly defying President Trump here. What's the view from Harvard's perspective?
Well, it's true. Harvard is the richest university in America. They have a $53 billion endowment. No one comes close. 70% of that money is restricted, so it doesn't appear as massive as it seems. But in theory, they could afford to try to spend some of that endowment. Last year, the endowment contributed $2.4 billion to Harvard's budget of about $6.5 billion. But the federal government has, they get a lot of money from the federal government, and I guess the question is, are they willing to risk it? And you saw President Trump on Truth Social just a few minutes ago saying, well, he's perhaps going after their tax-exempt status. So it's unclear.
Wow. I mean, I just actually had some experience over the weekend on this at a place of higher education about the finances there. And for top research universities, and this is a private-public relationship that really started after World War II, which is when the America said, we need to be the leader in key industries, technology, healthcare, so on and so forth. We think the best way to do that, this is the U.S. government after World War II, is a public-private kind of relationship. And right now, the relationship is about 2/3 federal funded, 1/3 private funding, including the universities themselves. That's big money for a lot of these universities.
It is big money, and we've written that many times. And the the federal government also gives students billions of dollars to attend universities in the form of federal student loans and Pell Grants and other grants. So colleges are quite dependent on the federal government, and they're exercising their views and saying, look, we give you a lot of money, and if you don't make changes, we have the right to take that away if they say if you don't follow the law. And in talking about their issue in some ways DEI, if you don't follow the law of they're saying discrimination, we can yank your money away.
So with the sources that you're speaking to, Janet, is the expectation that Harvard will remain resolute in this where they are right now, or do people think that they're gonna essentially cave? I mean, I saw you wrote a story earlier last month about the Columbia president stepping down, and I remember that they had initially been kind of trying to stand their ground as well. So what are you hearing from sources about what people are thinking Harvard might do?
Well, I don't think it really matters what people think. It matters how they're going to get through this, because they are dependent on the government for a lot of money. Now, if you look at Columbia is poor compared to Harvard. They only have $15 billion. So it's uncertain what happens next. I mean, the ball is in Harvard's court. Are they going to litigate? That could take quite a long time. What happens if labs are closing, or they're from past experience, we're going to get stop work orders. We've sort of seen this already with a couple of schools getting stop work orders and getting money frozen.
I mean, what are some of the alumni? Is there a consistent reaction from the alumni, either in support of Harvard or maybe not supporting them?
Well, I think some alumni have posted on various social medias. People are happy that somebody has stood up to Trump, but you have to remember the federal government has a lot of power.
Yes.
And perhaps $53 billion seems like a lot of money, but I mean, how much money does the federal government go through in one day?
So what are next steps here? I mean, I see that the Harvard has officially rejected the administration's demands here. So
we're in uncharted territory.
Okay.
If you asked me to predict any of this, it's hard to know.
I see in your story you say that former Harvard president Larry Summers says that the statement drew support from him. He said that he hoped other universities would adopt a similar stance to defend academic freedom. Is he alone in that, or are you hearing other people on the same side?
I think there is an interest in having entities try to stand up to Trump. We saw this with some law firms, but in some ways, the federal government holds all the cards.
What are other universities doing? Have we heard from anybody else? Has anybody been in a target like Harvard has?
Princeton has.
Okay.
Princeton's president has been outspoken. But keep in mind, Princeton, while they've produced many Nobel Prize winners, they do not operate a medical school. Most of the grants are NIH funding, grants to medical schools, grants for scientific research. There's only a handful of schools that are receiving the kind of money that Princeton, Stanford, MIT also does not operate a medical school, but they're had also received cuts in Department of Energy and Department of Defense. So remember, NIH is one federal agency. It's the biggest, but there's a lot of them out there. I believe Cornell had frozen funding from agriculture.
Interesting. I mean, and again, these are grants from the U.S. government in most cases to fund research and development.
Correct.
Right. They're not. These aren't. We're giving you money just to give you money. They're investing in research. They're buying research.
That is correct.
Okay. And earlier in the conversation, you mentioned DEI. How has Harvard been really viewing the pushback from the government on that? How have they been responding in about 30 seconds or less?
Well, we did a big story earlier this year about the decline in Black freshmen, first-year law students at Harvard Law School, and they have to follow the law.
All right, very good. Janet Lauren, thank you so much for joining us here. Janet Lauren, she's a higher education finance reporter. Again, talking about Harvard and its discussions and I guess differences with the U.S., with the Trump administration and the financial risk associated with that. So we'll have to see how that plays out. But again, a lot of large educational institutions, higher education institutions around the country, many of them receive a lot of money from the federal government to fund research and development. And for a lot of them, it's a key part of their economic foundation. And if that money is somehow at risk, that's a big problem for those universities. So we'll see how that plays out. We'll have continued reporting on that. S&P 500, it is up, holding its gains up 27 points. That's 0.5%. The NASDAQ also up about 0.5%. Yields are steady. 10-year Treasury yield 4.34%. Looking at the VIX, just right below 29 here. So keep an eye on the volatility VIX. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. I'm Amy Morris. Stocks edged up as solid results from big banks offset any news of an escalation in the trade war between the U.S. and China. We do check markets for you all day long at Bloomberg. The S&P 500 up 0.5%, NASDAQ up 0.6%, the Dow up 0.4%, the Russell 2000 index up 0.6%, the 10-year Treasury yield at 4.35%, and the 2-year yield now at 3.83%. The Bloomberg Dollar Spot Index now 0.3% higher. WTI and and Brent crude both about 0.3% lower, and gold is 0.3% higher. Boeing shares more than 1% lower after sources told Bloomberg that China has ordered its airlines not to take any further deliveries of the company's jets as part of trade wars between Washington and Beijing. President Trump responded to this, criticizing China for reneging on the Boeing deal, posting on social media that the U.S. will protect farmers. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That is a Bloomberg Business Flash. Now back to Bloomberg Intelligence with Paul Sweeney and Nora Melinda.
All right, Amy Morris, thank you so much. We appreciate that. Nora Melinda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube here. Looking at the markets, as Amy is just reporting, we do have green on the screen here, but volatility has been the name of the game. And for Tom Keene, I'll call out the VIX. Just under 29. Anything above 20 really starts to get your attention there. When you get up to 30 plus, then there's some angst in the market. And we hit 50 last week, but it seemed to have calmed down a little bit here. But let's talk to somebody who does this stuff for a living. Gaurav Malik, Chief Investment Officer for Palace Capital Advisors, joining us from Braintree, Mass, via that Zoom thing. Gaurav, you talked to your clients over the last several weeks. What's the message in terms of the volatility we're seeing in the stock market, the bond market, in currencies, pretty much everywhere you look there, with the exception of gold? What are you telling your clients?
Oh, well, number one advice to tell clients is, again, horizon matters a lot in these situations. And you and I know this going through various up and downturns in markets, that if you have a long enough horizon, sometimes these opportunities do give you a chance to potentially re-risk. We think at the current levels, call it somewhere around 19-ish multiple, the S&P is reasonably balanced in terms of risk reward. It came in the year at 21, 21.5. I mean, that seemed a little expensive given that we were at peak margins. Earnings growth expected over the next few years was, single or even double-digit earnings growth. But today, the market has taken all that into account. The market is no longer expecting these companies to maintain their margins. They're no longer expecting a high double-digit earnings growth for the rest of the year. Given that, we feel the market is striking a slightly better balance, taking into account, again, an expectation that perhaps the trade war is not going to intensify or worsen than kind of what's in the price right now, which is that there will be some reasonable conclusion at the end of this 90-day period.
Mm-hmm. But are they really fully pricing in the full impact here for tariffs? I mean, of course, we had last week the administration deciding to do the 90-day pause for tariffs. But of course, we do know that import tariffs are still 10%. We have China that has tariffs of more than 100%. And then, of course, the existing ones that we have on steel and other products as well. What do you think the market is thinking right now? And what should they be thinking?
So I think that my sense is that 10% is being absorbed. But I don't think the full impact of the, call it the 145% on China, the average of something between 25 and 35% across various countries, I don't think that's in the price at all. So if those are the scenarios that start playing out, the market definitely has a leg down to go. I mean, it would not surprise me. I mean, think about it like this. Suppose we agree that the fair value multiple, let's talk about that for the S&P for a second, right? Last 5 years has been around 19.5, whatever. Last 15 years have been around 18. You look at the long-term history, it's been around 15 to 16. If you're facing a situation where companies are going to see the full impact of these tariffs, which means they're not going to be trading anymore at operating margins, peak operating margins, I think we can test easily 18. So I think 18, if not 16, can be tested in those situations. So I don't think the market is taking that into account. Now, as we look at client portfolios, as we think about those things, we've generally been trying to barbell the portfolios, which means keep some market risk on, but also hold some amount in cash. The other sad thing with this volatility moves has been that duration has not been a really good hedge through this period, right? So got to think about that aspect too. But to your very specific question, I don't think the market is pricing in those scenarios.
Given that background, which is quite cautious, how does fixed income play in a portfolio these days?
Fixed income has been super interesting in some areas, in some ways, right? I mean, when you look at the last few days of the worst moves in markets and you look at the behavior, it's interesting. Some days we've seen that actually credit has outperformed duration. So there's this clear sense that when things get really tough, because of the fact that you have highly levered positions occurring in the treasury market, that's where everybody's going to basically trade and get the liquidity. then even something like AAA credit behaves a little bit better because you don't have the same amount of liquidity as you do with those duration assets. So in fixed income, you've got to make trade-offs as to where you want to be. For the most part this year, we've been, well, entering the year, we were sort of neutral on duration, even though everybody was talking about steepness at that stage, because movements, frankly, in the marketplace were so dramatic on each economic announcement that it did not make sense to make too much of a bet one way or the other. But heading into this bout of volatility, we were short duration. So I think that part paid off. But I was only marginally, frankly, periods where equity markets were down, bond markets were down too. So emphasis there is really look at income and really look at some barbelling between short end, which still is giving you some protection, and then find ways to lever up with credit on the other side to create that balance in investor portfolios. And look for other hedges, gold being one of them, that seems to have played out reasonably well in this bout of volatility.
So I know we've talked about everyone's looking at the uncertainty and everyone wants to know where the safe havens are. I know that you say that the opportunity right now is in high quality and cash generating sectors, and you note utilities and healthcare. But of course, we know that Trump is also pressing forward the plans to impose tariffs on some of those pharmaceutical imports. In about 20 seconds or less, would you mind telling me what you see as some of the safe havens?
So utilities for sure. I think we see that as a safe haven. Healthcare too. I think that when you look at the diversity in the sector between companies that are providing insurance, companies that are in the PBM space, the pharmaceutical companies themselves, and biotech. I think our take on it is that there is still enough cash being generated in that business that there is room to reinvest. Pipelines actually are looking pretty reasonable and pretty strong across these companies. So the hope is that ultimately innovation will win out. So there might be some trade-offs to make in terms of taxation, the fact that companies have shifted their headquarters to Dublin. So I think there'll be some trade-offs to make on the supply chain side. But I think the innovation and the ability these companies have with existing cash to fund that is what we find attractive in this period.
Gaurav, thank you so much for joining us. Really appreciate it. Gaurav Malik, he is the Chief Investment Officer for Palace Capital Advisors. Well, yesterday, U.S. Treasury Secretary Scott Bessent sat down for an exclusive interview with Bloomberg's Anne-Marie Horton in Buenos Aires, Argentina. They discussed the strength of the U.S. dollar and the toolkit to keep the economy stable in light of the administration's changing trade policy. Bessent began this portion of the conversation by talking about the state of the U.S. dollar as a reserve currency. Let's take a listen.
We are still a global reserve currency, that we have a strong dollar policy. The dollar can go up and down. If you go and look back at President Trump's first term, I don't remember the exact number, but the dollar in 2017 went down, I can't remember, 7, 8, 9%, and then once the tax bill was done, took off for the remainder of his term.
Have you spoken to the Fed at all about contingency plans, though, if financial stability risks flare up?
Chair Powell and I have breakfast every week, and we discuss a wide range of things. And our staffs are always in contact. We have a markets room; they have a markets room. But and specifically, did we discuss some kind of a break the glass? I think we're a long way from that.
So when was the last time you guys spoke? You had breakfast last week?
We had breakfast last week, and it was an away game. I was over at the Fed.
And no concern so far from the Fed chair on what he saw in the Treasury market?
I think we would have heard from the Fed chair. I think we heard from Governor Collins of Boston on Friday. We heard from Governor Weller today on his thoughts on what tariffs mean. So seems like business as usual.
When it comes to the Fed chair, his term is up May 2026. So we're almost 12 months out from that. When are you going to start to think about, have these discussions with the president about who should lead the Fed?
Well, we think about it all the time. I think when are we going to start the interviewing candidates? And that'll be sometime in the fall.
In the fall, so about 6 months lead time.
Yep.
The U.S. Supreme Court recently came out with a ruling that the executive branch, the president, for now, could oust top officials at independent agencies. And that has some individuals in the market a little bit concerned about what this could mean for the independence of the Fed, which is really a cherished pillar of wanting to invest in America. Do you have any concern about potentially President Trump ousting Fed Chair Jay Powell or the independence of the Fed?
Well, and Marie, I've repeatedly said the Fed has two duties. And I believe that monetary policy is a jewel box that's got to be preserved. And then they have regulatory policies. And I think we can have more of a discussion because the Fed is one among three bank regulators. There's the Fed, controller of the currency, and the FDIC. So I think it's very easy to delineate between those two.
So at the moment, no concern?
No concern.
When you talk to Fed Chair Jay Powell, at the moment it doesn't sound like they feel like the need to step in on this unraveling we saw last week with the bond market. Does the Treasury have any plans to do something if this was to become more unnerving?
Well, look, the Treasury has lots of things we can do, and but again, I think we're a long way from that.
But all options would be on the table?
Sure. But again, we have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted.
All right, that was U.S. Treasury Secretary Scott Bessent speaking in an exclusive interview with Bloomberg's Anne-Marie Horton in Buenos Aires, Argentina, talking about a lot of economic policies, including the U.S. dollar. I'm looking at the Bloomberg Dollar Index today. It is higher by about 0.1%, but it is off about 6.8%. Just in the past a couple of months, we've seen some selling pretty much across the board of the U.S. dollar from domestic and international holders. That's been reported. So, and some even questioning the dollar as reserve currency, but I'm not sure what the alternative is.
Right.
So I'm not sure we're anywhere near there. But again, the dollar's a little bit stronger here today. We are seeing some strength in the markets. We've got the equity prices up about 0.25%. We got bonds pretty steady here with the 10-year Treasury about 4.3%. And, more move higher in gold. Think back to that Goldman Sachs call of maybe 6 months ago calling out 3,100. Boy, were they right. I didn't think it would happen that quickly, but we got 3,220 for gold. And Bitcoin for Tom Keene, it's up a little bit here today, just above $85,000 per token. And looking at, again, the VIX here coming in just below 30. It's 29.2, so we keep an eye on the volatility. Coming up, Mark Gurman, Bloomberg News managing editor for Global Consumer Tech, on the latest from Apple. Mark Gurman from Bloomberg News is the axe on Apple. Breaks most of the news associated with this company. We're going to get a few minutes of his time coming up. This is Bloomberg Morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. I'm Amy Morris. Bank of America posted a record quarter as the company reaped the benefits of volatile markets and net interest income topping analyst estimates. CEO Brian Moynihan spoke on this morning's earnings analyst call, forecasting no recession or rate cuts this year.
Our research team, like many research teams led by Candace Browning, does not currently believe we'll see a recession in 2025. However, they've lowered their GDP growth rates for 2025 and continue to see no rate cuts during 25, but expect as inflation gets under control, you may see them in the future.
Revenue from equity trading rose 17% in the first 3 months of the year, helping Bank of America beat analysts' estimates for per-share earnings. BofA shares are more than 4% higher. A rally in Wall Street's lenders lifting stocks. We check markets for you all day long here at Bloomberg. The S&P 500 up 0.3%, NASDAQ up 0.3%, the Dow up 0.2%, the 10-year Treasury yield at 4.34%, and the 2-year yield at 3.83%. Elliott Investment Management has built a large position worth over $1.5 billion in Hewlett-Packard Enterprise, planning to engage with the company to boost value. HPE stock has fallen roughly 33% this year, but today, HPE shares are nearly 4% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Intelligence with Paul Sweeney and Norma Melinda.
All right, Amy Mars, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We are live in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Tariff news. I guess the latest big thing is President Trump talking about an exemption for a lot of the tech companies bringing in iPhones and chips and computers and all that kind of stuff. And that was a big relief for a lot of folks in Silicon Valley, most notably Apple. Mark Gurman joins us here. He is the technology reporter in Los Angeles, covers all the big tech names, including Apple. He's just the absolute axe on all things Apple. Mark, it feels like Apple probably dodged the bullet, but I don't know how long that's going to last. I mean, it could be a tweet coming in 15 minutes.
That's the big question. We're on a bit of a roller coaster here where Apple's constantly needing to think about adjusting, and then how are they going to adjust, and then what happens if they adjust, and then they have to adjust in a different direction. You can really think of Apple as just like the biggest ship in the water. Yep. It's going to take a while to move anything. So these adjustments, they have to be made with precision, right? And so it's a sporadic situation. You really don't know what's going to happen, but at least for now, they're in good shape. Mm-hmm. But to your point, who knows how long that's going to last. But no matter what Trump does moving forward, I'd be very surprised if he talks about this sectoral tariff on these types of devices. Maybe I'm wrong. I just don't think there's any way it's going to be the 145%. So either way, you're still at a big improvement from what it was a few days ago.
Mm-hmm. If you look at the stock, we see Apple down about 19% this year. And of course, with the tariffs as an added layer of a headwind for the company, they're not stockpiling. And so we're seeing them increasing shipments and everything. But it seems as though this isn't necessarily due to more demand, but more or less the fact that they're just trying to prepare for the worst. Is that the case?
Yeah, that's right. Try to get as many phones at no tariffs or at low tariffs as possible, whether it's from China during this period right now with no tariff, whether it's from India at this period with the lower tariff. Get as many as you can into the U.S. channel to fulfill demand. The problem is that we're about to go through a product transition, right? They're about to move to the iPhone 17. So the question,
I just got the 16, dude.
I'm behind.
Yeah, that's
14
fine.
here,
But the point we're trying to make here, yes, you are behind. You're also behind. But but the point I'm trying to make here is that these iPhone 17s are not ready to be pumped out. So the question is, what is the tariff situation going to be in September, October, when these things are flying off the manufacturing lines? Where are these going to come from? So at this point, it's so difficult to figure out what's going to happen. What do they need to do?
In reality, I can't imagine China not being an integral part of Apple in the next 5 years. I mean, it has to, right? You can't switch.
Nothing's changing. Well, that's not true. Things are changing, but China's not going away.
Yep.
Right? Don't forget that the U.S. makes up about, a third of Apple's overall sales. You still got 2/3 of the world that's going to rely on this China supply chain. China is critical for the rest of the world.
So how's Apple doing in the AI game right now? I mean, so I know we have iOS. What's going on there? I know we have iOS 18.5 or something coming soon.
That's coming, but Apple AI is not doing so hot.
Okay.
They just replaced the person in charge of Siri, right? They're pulling any lever they can. One of the issues with Apple Intelligence is that their privacy stance has prevented them from gathering as much data possible in order to train their AI models. To get AI models working properly, you have to train them with data, right? And the best data you can get is the data that your customers are inputting into their iPhones. They don't do that. OpenAI does it, Google does it. That's why their tools are so great. What Apple's doing now is they're putting in this new privacy-centric approach where they're going to take your data on your phone, analyze it on the phone, compare it to the fake data, right? They use fake data that they just create out of thin air, well, using AI, compare it so they know which fake data is most similar to the real data, and then they'll use that best of the bunch fake data to train their AI model. So you're seeing these. It is complicated, hard to wrap your head around, and so they're basically pulling every lever they can.
Now, we've said in the past, Apple doesn't need to be first in things because they just need to wait till the technology's kind of out there, and then they're going to come in and make it beautiful. Is that still hold for AI?
That's the problem. The usual playbook, you're right. Don't be first, be the best. Well, they're certainly not first.
Okay.
And they're probably the worst.
Wow.
Of all the big tech names. They are the worst in AI of all the big tech names.
How concerned are they at Cupertino about that?
I mean, it's extremely concerning. They were going to have the head of AI retire, perhaps. He's not going anywhere. They just replaced him on Siri. There's certainly a lot of work and accountability that needs to be done there. And the question is, how long is it going to take till you have something compelling? And I do think it's going to be at least a few years. But don't forget, AI is not the phone. The phone moved fast. But there was new innovation in the phone maybe, every year, every couple of years. AI, you're getting a new DeepSeek every 3 weeks. Wow. There could be a big AI innovation announced tomorrow. In fact, I think OpenAI just rolled something out, ChatGPT 4.1 model the other day or yesterday. And so the speed at that this moves at is what's really concerning, because Apple just doesn't move at that speed. They're not built to operate at the speed of these other AI companies.
Can they buy their way into this market?
I think they can, but that would also require a big sea change, because Apple's historically bad at integrating larger companies into their overall operational workforce. And so it's like you take a step back and you ask yourself, what is Apple really good at? They're good at the phone. They're good at the iPad. They're good at the watch. They're good at health stuff. They're good at core on-device software. Not really good at cloud, though they have some excellent cloud-based services at this point. Not really good at AI. They're getting good at TV from, what I hear from people who like their shows. But they're just a company at this point that's running based on legacy ideals, and they need a bit of modernization. And the question is that going to happen? Don't forget, this company is run by the same group of people.
I was just going to ask, does Tim Cook still have the support of the street and of the board? And Silicon Valley?
Tim Cook wouldn't write his own ticket. There's no question there. They're down 19% this year,
right?
But look how much they're up over the last 15 years. What he's done is amazing. Everyone counted him out after Steve Jobs passed away, right? Steve Jobs is a one-of-one innovator in mind on this type of thing. And it would have been very easy and not surprising if, Apple not folded up shop, but really moved away from what they were.
Yep.
And in many respects, they have moved away. But at the same time, they've grown so much.
Yep.
The way Apple's at the center of all our lives today was not the way they were at the center of our lives 10 years ago. They were not at the center of the universe a decade ago.
Yep.
They're at the center of the universe today.
Yep.
Because Steve Jobs left them with a lot of momentum. And Tim Cook executed better than anyone else would have been able to execute.
Yep. All right, Mark, thanks so much for being in our studio. We know you're LA-based. We appreciate getting a few minutes of your time in our studio. Mark Gurman, Managing Editor for Global Consumer Tech for Bloomberg News. When we want to know about Apple, we talk to Mark Gurman. Stock Apple pretty much unched on the day here, but as Nora pointed out, down 19% year to date, up 17% on a trailing 12-month basis. So it's been all over the place. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Norma Linder is sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube as well, so check us out there. The big take story is a good one here, as they all are. GM and its 8-year, $35 billion EV bet brace for tariff hit. The automaker is up against tariffs, an oil-loving president, and Elon Musk in the White House. David Welch, he's the author of that Bloomberg Business Week story. Again, it's a big take story. David Welch is a Detroit bureau chief for Bloomberg News, joining us from Detroit. David, tough times for our friends at General Motors, Mary Barra. Boy, they got a lot on their plate. How do you kind of think about that?
If you look at Trump's policies, they're pretty tough on all the car companies, right? I mean, you've got this tariff regime out there that still hasn't been sorted out. Trump has indicated that he might have some leniency in the offing for car companies, but they've built up the supply chain and assembly in the U.S., Canada, Mexico, and other places for decades now. They have made more investments based on USMCA, which was a Trump trade deal, and now that could be upended. GM makes 2 of its EVs in Mexico. It's 2 of its cheapest ones, the Chevy Equinox and Chevy Blazer. And so it makes it tough from that standpoint for those 2 vehicles, and some of the parts that come in for those vehicles. And then generally for GM's business, tariffs are just not a good thing. They import vehicles, they import components, all of that. That makes it tough. Trump has also said, he hasn't done it yet, but he said that he wants to get rid of the Biden-era Inflation Reduction Act. Those are up to $7,500 in tax credits for people who buy EVs. That makes GM's life difficult with this big investment they have out there. And there could be relief on this. There are ways to get around it. But if you're General Motors and you've got a dozen EVs out there, the program on the whole loses money, they're improving the profitability, but it does lose money. You know, the pressure's really on, as it always has been, but even more so with Trump policies, to get those vehicles to a break-even or a profitable level and then sell them in big enough numbers where you continue to get economies of scale and you can drive the cost down. So it's not impossible. They're working hard at it, as we have a lot of detail on in the story in terms of reducing battery cost, improving efficiency at the assembly plant level, that sort of thing. But it's hard work, and EVs, this kind of transition was always going to be difficult. It is for everybody. But you know, in GM's case, they've done some reining in of investment, but they've really continued their push, and some of their rivals have reined it in, pulled back in the face of all of this. So GM's sticking with it, and they're really working hard to make it profitable.
David, as you said, the pressure is on. Does CEO Mary Barra really have a dog in this fight to electrify GM in the EV space? I mean, of course, she's trying to get a little bit of a peek into Tesla's playbook by hiring some of their veterans from Tesla, but do they really have the brand recognition that they need to push through on this charge?
Yeah, that's a tough one. I think what they're trying to do here is they're trying to change that, right? So one thing they'll point out is, one, they doubled their market share in the EV segment, the EV space in the U.S. over the past year, and they did even better in the first quarter. So they've got some sales momentum, and they're doing better on the coast, which is where most EV buyers are. But it is a bit tough when Chevrolet, for example, known for big pickup trucks, known for Chevy Suburbans, Cadillac, known for the Escalade. You know, these are pretty thirsty and pretty expensive vehicles. They tend to do well in the middle of the country and in the South. So for GM, you can see why they want to push this, right? They've got brands that do better in Middle America. And if EVs are bought on the coast and you can get market share there, why wouldn't you push for that? It does bring in a different kind of buyer. And I think there's a bit of chicken and egg here. Does the brand hurt them from selling EVs, or does selling EVs help get recognition for these brands with people who didn't look at them before? And I think that's the case they're making. And they're having decent sales success, so there's a bit of momentum there while they're trying to do it.
David, tell us about the Ultium Cells factory outside of Nashville, Tennessee.
Okay, it's very similar to the one in Ohio, and it's fascinating to walk through. These are pretty well automated operations. It's not like when you walk into an assembly plant and you see workers swinging say a set of seating for the interior over on robotic arms and putting that in, or bolting engines. Like they're watching computers, they're watching automated machinery that mixes chemicals or puts that chemical slurry onto a metallic sheet to make parts of the battery components. A very different type of thing. If you walk through a battery plant, or I should say a cell plant, it's kind of more like a chemical facility than it is like a traditional assembly plant.
All right, and that's out in Tennessee, and that's part of the supply chain that they're thinking about here. David Welch, thank you so much. We appreciate that. David Welch, Detroit Bureau Chief for Bloomberg News, joining us from Detroit. He's author of the Bloomberg Business Week. It's a big take story here. General Motors dealing with tariffs, dealing with the change to electric vehicles and the challenges there. I'm looking at the stock for General Motors. It's off about 1.8% today, but it is off 17% year to date. So again, General Motors, as well as I think all global auto companies, are trying to figure out how, you know, the switch to gas internal combustion engines to EVs is tough enough.
100%.
And now I need to navigate a world where trade is going to at least, it seems to be restricted to some degree. So that is a
quite
challenge.
The obstacle course.
Yep, quite the obstacle course. Just a quick snapshot of these markets. The S&P is up 20 points. That's 0.4%. The NASDAQ's up about 60 points. So holding on to some slight gains here. That's about 0.3% of 1%. Yields are steady. 10-year off about 3 basis points, 4.33%. Gold higher, up another $10, $3,200 for an ounce of gold. WTI crude oil, around $61 per barrel. Balance of Power with Joe Matthew from Washington, D.C. is next after this global news update. Good morning.
This is CBS News on the Hour, sponsored by Steel.
I'm Steve Kathan. The case of a man mistakenly deported to El Salvador is back in a Maryland court today, as the Trump administration gives no indication it's willing to work to get him returned, as the Supreme Court had ordered. CBS's Katrina Kaufman.
I'm expecting this hearing today to be highly contentious. The judge had very specifically said that the government has to take steps to bring back Mr. Abrego Garcia to the country. We are seeing that completely flouted.
A Palestinian man who led protests against the war in Gaza as a student at Columbia University was arrested at a Vermont immigration office where he expected to be interviewed about finalizing his U.S. citizenship. CBS's Lilia Luciano.
The interview started. We noticed that there were people outside, that there were friends of his who were there standing by, but there were also very clearly, I noticed at least a couple of agents, and there were some cars roaming. And suddenly we got a text minutes after the interview began from his attorney saying he's in handcuffs.
On social media today, President Trump threatened Harvard University's tax-exempt status hours after the administration froze more than $2 billion in federal grants when the school refused White House demands. CBS News Boston reporter Julie McDonald.
Harvard said that addressing anti-Semitism remains a priority, strengthening their rules, expanding training, and supporting their Jewish community, but that curtailing research funding would not help with this important work.
Also on social media, President Trump today accused China of going back on a major Boeing deal after Bloomberg reported that Beijing ordered Chinese airlines to stop taking further deliveries of the company's jets. Jury selections underway in New York in the sexual assault retrial of ex-Hollywood mogul Harvey Weinstein. His first conviction was tossed out. Attorney Lindsay Goldbrum represents one of the plaintiffs.
Over the next several weeks, these women will testify about these heinous acts that have been committed against them, and intimate details of their lives will come out.
Well, correspondent Christian Benavides tells us the trade war appears to be playing a role in how Canadians view the United States and in what economic actions some are taking.
Nationwide, advanced flight bookings by Canadians are down 70%. The country is the top source for international tourists to the U.S., generating $20 billion in spending. Canadians are getting out of U.S. real estate, too. Natalie Mancuso sold her condo in Pompano Beach.
It was definitely political.
Checking Wall Street, right now the Dow is up 136 points. The S&P is up 26. This is CBS News. There's a move underway to canonize a 19th century architect who left his mark all over a coastal city in Spain.
Pope Francis has put a celebrated Catalan architect on a path to sainthood. The next step would be beatification or verification of a miracle by Antoni Gaudí, a devout Catholic who was nicknamed God's architect for his work on Barcelona's Sagrada Familia Basilica, which began in the 1880s. The construction lasted for more than 4 decades and remains unfinished. First, Gaudí was hit by a tram in Barcelona in 1926 and taken to a hospital for the poor because no one recognized him. He died 3 days later. Deborah Rodriguez, CBS News.
The Justice Department's charged a man with vandalizing a Tesla dealership in New Mexico and setting fire to the headquarters of the state Republican Party. Prosecutors are going to seek a prison term of up to 40 years in the case. Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Tax Day edition in the age of the Doge. We're joined ahead on Balance of Power by Bloomberg's Laura Davison with us live in Washington as we go behind the scenes at the IRS. After more than 7,000 workers at the agency were fired. What does that mean for your returns? We'll find out in a moment. President Trump criticizing China for what he calls reneging on a deal with Boeing. We're going to get the story ahead from George Ferguson at Bloomberg Intelligence. And look who's back. Former President Joe Biden. Yes, speaking today on saving Social Security. It'll be part of our conversation with our political panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us for the hour. And it's good to see you back here on Bloomberg. We start, as always, on Wall Street. For that, we turn to Amy Morris for help on the markets. Amy, how's it look?
It's looking pretty green, Joe. Thanks so much. Equities are on the rise. Bonds are stabilized after Treasury Secretary Scott Bessent downplayed the recent sell-off and big banks rallied. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.5%, NASDAQ up 0.5%, and the Dow up 0.3%. The 10-year Treasury yield at 4.33%, and the 2-year yield at 3.84%. Mike Wilson is Chief U.S. Equity Strategist at Morgan Stanley. He says markets have not bottomed out yet.
It takes time to heal. And so what we're looking for is sort of a backing and filling, choppy market for the next, month or two at least. Maybe it goes further than that.
Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. Healthcare giant Johnson & Johnson posting better than expected first quarter earnings and revenue and boosted its full year sales outlook to reflect the acquisition of drug developer Intracellular Therapies. Johnson & Johnson shares now about 0.5% lower, and Citigroup stock is more than 3% higher after it posted first quarter earnings of $1.96 per share, better than Wall Street estimates, inching closer to a key profitability target in the first quarter. Chief Executive Officer Jane Fraser reorganized that bank, hiring leaders from outside the firm and cutting thousands of roles. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Balance of Power now. Joe Matthew.
Amy, thank you so much. With us from Washington. Good to see you on Bloomberg Radio, on the satellite radio, channel 121, and on YouTube. Search Bloomberg Business News Live, and we'll meet you here in the studio on what is the Tuesday edition, the early edition. Kaylee Lyons will join us about an hour's time as we welcome our global television audience to the conversation. And yes, I am back from the dead here. Good to see you. I missed you. Same news. I was actually doing my best to avoid the news flow over the weekend, and I couldn't. If you walk by a TV screen, you see Donald Trump or someone talking about tariffs. Maybe it's the Doge. It's a pretty interesting news cycle that we're in here, and the whole idea of Doge cuts takes on new meaning on this tax day, which is where we start our conversation with Laura Davison, Bloomberg Politics editor, with us here at the table. It's great to see you. We were told during the Biden administration by Jen Psaki that this was an agency so woefully underfunded that it couldn't get the job done. That was a couple of years ago. What's happening behind the scenes today after 7,000 workers were cut?
7,000 workers were cut. So what really, let's go back just a couple years. They passed all this new money. They really beefed up their enforcement efforts. They realized that they were there was a lot of tax cheating that was happening. And so they said, look, we're going to put up all these defenses. They did that under Joe Biden. Now we have 7,000 workers, probationary workers, cut from the agency. We have about 5,000 workers who took the first buyout. And just now, just across the terminal, another 20,000 workers who are taking the second round of buyouts.
Wow.
So that means that the agency is going to be down, somewhere close to 30 plus thousand of its 100,000 people, which it really raises a lot of questions of, what functions do they have left? What are their audit capabilities going to be left? If you need to call the agency because you have a tax problem, today your filings are due really soon, are you able to reach anybody? This is really causing a lot of concern that the U.S. revenue arm just suddenly doesn't have the ability to do its job.
Were these all enforcement workers? What were they doing? The 20,000 on top of the 7,000?
So these are from all across the agency.
Okay.
So these are people, the probationary, that 7,000 were people who were just in their first year or two in any specific job. 20,000 were people from all across the board. But the IRS has a bunch of people, from people who are answering the phones and call servers to people who actually carry guns, who are walking around going after drug dealers and other people who are committing very complex financial tax crimes. So
what about the 80,000 armed agents who are going to be knocking on our doors? Did they ever materialize?
They never did. That was really never in the plan. But there was a call to expand the IRS's capability, have more tax enforcement. We heard from Charles Rettig, who was the IRS commissioner in Trump's first term, who said that they were totally outgunned, metaphorically there, by big corporations, that they just weren't able to go in and audit, and that big companies, people with complex tax issues, were just able to get away with a lot because they didn't have the resources to dig into those details.
So do we have a sense of what this means for revenue, or we have to give this some time?
Both the IRS as well as outside estimators have suggested that this could be very, very bad for revenue. A couple different things. One, if you just have people who say, I might take a little bit of liberties if I don't think anyone's looking. Okay. Two, you also have the IRS now sharing tax data with immigration officials. And so you have a bunch of people who may be undocumented who pay taxes. They pay payroll taxes. They don't actually get anything out. But estimates that could cause, tax collections to drop by, hundreds of billions of dollars over a decade. Suddenly, and why this really matters is the IRS and the Treasury Department is closely watching these tax collections for the debt ceiling, which is coming up potentially between May and September. That's a wide window. If they come in really weak over the next couple of weeks, that could suggest that Congress is now barreling towards a debt ceiling crisis.
Wow. Boy, well, it's an interesting layer here. It's not just the idea of the government being shortchanged on revenue that lawmakers are planning for and allocating around, funding government agencies and programs. But if this brings the X date up, this is a Republican-created problem that then Donald Trump has to manage with lawmakers. Do we have any reason to believe that the party sees eye to eye when it comes to the debt ceiling?
We don't, and we've already gotten some people who voted against that budget resolution last week who said they didn't like it because it paired the tax cuts with this debt ceiling increase. Here's how this plays out. There's kind of basically two options. One, lawmakers come back. If the debt ceiling is sooner than they expect, they may have to separate the tax cuts from the debt ceiling and then work with Democrats. That's the most likely scenario. Or they're able to keep their very, very narrow majorities together, push something through, but then the tax bill may not be fully thought out. This is going to cause a lot of issues. We may come really, really close to that X date, freaking out bond markets even more than they've been spooked in the past couple weeks.
Wow.
So there's basically no good options if tax collections are slow.
Where are we on tariffs today, Laura Davis? And I see one of the most read stories on the terminal has to do with the European Union clearly preparing for the worst.
They are seeing that they're, basically no EU countries are at the front of the line for these talks. That's Japan, South Korea, India. They're seeing that they may be in for a long haul on tariffs and that they're going to have to figure that out. We hear Trump talking about some of these exemptions potentially on auto parts, but in the same breath, yesterday he also said, okay, that these investigations on pharmaceuticals and semiconductors, basically a wide range of technology products are coming, meaning that, the tariff rate broadly is going up, not down.
When do we find out about Chips Pharma and the rest?
They have to do these investigations.
Yeah.
So this could be, they could do these in a matter of weeks, could take months. But essentially, the administration has signaled they have made up their mind that they're going to go forward with these. They just basically need to go through the legal process to get those done.
That was an interesting sort of back and forth over the last couple of days on exemptions. We're going to have some, we're not going to have any. We're putting this up to study. They're all coming eventually. Will this all be wrapped up or in place by the end of the first 100 days? I saw this morning that's coming up pretty quickly here. It's the end of this month.
That's basically 2 weeks from now. Yeah. I think that it's unlikely that we'll see sort of the end of this. There's also some other tariffs too that Trump has talked about that haven't come into place. Things like lumber. He's talked about copper. There's a whole range of things here, and just the sheer volume of what they have to do is going to be very difficult.
Can you believe that 100 days? It seems like 100 years according to some people, and your team probably can relate with that, much like you. But what's the second act? I mean, we've really spent the first 100 days talking about tariffs, tax cuts, even though they haven't come to fruition on Capitol Hill, and I guess mass deportations, right? We spent a lot of time talking about immigration. Will this be the same conversation as we work through the first year, or is there more on the agenda for this president?
Republicans are really eager to shift away from this tariff talk, and what they want to talk about is tax cuts. I think as we head into that next 100 days, that's going to be the key focus as they try to move this through the Hill. There's going to be a lot of Republican infighting. Just the taste that we got as they tried to move this budget resolution is going to be what it's, what the dynamics will be kind of May, June, July. That's when they hope to pass that tax bill. We also have seen, the president really dig in on things like this fight with Harvard, on the Maryland man deported to El Salvador, some of these legal fights, these sort of public relations fights. I can really see Trump digging in on these, where he sees, a popular advantage on deportations as well as picking fights with Ivy League universities.
That's a whole other one that we haven't even touched on, the Harvard story today. When you back off from all of that, though, this idea of getting through reconciliation is a very challenging one for the House and for the Senate. What are the odds that this doesn't work?
That's a great question. I think that they almost have to get it done. What
They
the
have no
what the
choice.
bill looks like is sort of irrelevant. They
Yeah.
will get something done, because if they don't, all of those tax cuts expire. So
Imagine.
that's sort of the anvil that's hanging over everybody's head of, if you don't get this passed, it's a $4.5 trillion tax hike on all of your constituents. You let Trump's signature bill from his first term expire, and that would be sort of political suicide for them. But it's going to be a lot of beg, borrowing, and stealing to get everybody on board, because you just have a lot of people who want a lot of things, and they just don't have the ability to make everybody happy in this
So
bill.
you could argue that as well. If the tax cuts expire, does that guarantee a recession, since we're apparently teetering on one already? This is what we keep hearing.
Economists have actually suggested that they're not too worried about the tax cuts expiring in terms of a recession. These are largely tax cuts that benefit households, some small businesses, things like the child tax credit. These are not taxes on businesses, at least, won't go up that much. All of those cuts from Trump's first term are permanent. So in terms of kind of economic growth, there's two sides of this coin here. If the taxes go up, it's not totally damaging the economy, but you also, by renewing them, don't get a lot of economic boost. So it's a little bit more money in the pockets of people, not a lot to have a major impact on the economy one way or the other.
This is not an administration preparing for a recession, is it?
They are not. And
Despite the talk.
we've seen them say 100% no recession. That's a bad quote if perhaps a recession does come in the next couple months.
Isn't that the truth? Laura, thank you so much. Bloomberg Politics editor with us here live in Washington, getting us up to speed here today. We will hear from Donald Trump a little bit later on. Presumably, there is an Oval Office event about 3 hours away in which he'll be signing some executive orders. And then, as I mentioned in the outset, we're going to hear from Joe Biden later on today. Will this be the big talker tomorrow? Joe Biden back on the national stage? He's going to be talking about another target of the Doge we haven't mentioned yet, and that's Social Security. That's going to coincide with the late edition of Balance of Power, the former president of the United States speaking a bit later on today. I'm Joe Matthew in Washington. I missed you. We're back. I'm sort of back to life. And we'll have much more straight ahead as we get back to the tariffs and the idea of China pushing back on the U.S., which could mean bad news for Boeing. We'll have a lot more on that with George Ferguson coming up from Bloomberg Intelligence on the fastest show in politics. This is Bloomberg.
It's 12:21 on Wall Street. I'm Amy Morris. Stocks edging higher as solid results from big banks offset any news of an escalation in the trade war between the U.S. and China. More on that in just a second. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.3%. NASDAQ up 0.4%. The Dow up 0.2%. The 10-year Treasury yield at 4.32% and the 2-year yield at 3.83%. The Bloomberg Dollar Spot Index about 0.5% higher now. Brent and WTI crude oil both about 0.6% lower, and COMEX gold about 0.4% higher. Boeing shares right now about 0.3% lower after sources told Bloomberg that China has ordered its airlines not to take any further deliveries of the company's jets as part of the trade war between Washington and Beijing. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Balance of Power with Joe Matthew.
All right, Amy, thank you so much. With us on the fastest show in politics, we'll be back to Amy with an update on the markets a short time from now as we consider the top stories today on the terminal. This is the latest here from Bloomberg. Just a scan of the headlines. EU expects U.S. tariffs to stay as talks make little progress, right? The big take, auto tariffs add new hurdle to GM's $35 billion EV bet. Great story, by the way. Number 3, China orders Boeing jet delivery halt as trade war expands. Are you sensing a theme here? It's still all about tariffs and the uncertainty surrounding them, whether we're talking about sectoral tariffs, some of the reciprocal tariffs that are already in place, maybe those that are being investigated right now for chips, pharma, and so on. If you listen to this program or you watch us on YouTube, you already know about this stuff already. And we're going to be hearing more about them coming up. This White House press briefing at the top of the hour might fill in some blanks or not. It's a big part of the reason why we spent some time, had a chance to check out Kayleigh Lyon's conversation with Janet Yellen. A perfect time to speak to the former Treasury Secretary, who was also, of course, the chair of the Federal Reserve, and her take on the impact of these tariffs, what they mean for the global economy, and the trade strategy for this administration. Let's listen.
It was suggested that these reciprocal tariffs are in response to unfair trade practices. That clearly wasn't the case. And for example, with the European Union, the trade barriers are very, very low. So I must say I'm confused about what the Trump administration will be looking for with Vietnam, for example. We actively encouraged Vietnam to begin to produce goods that we were dependent on China for national security purposes. We wanted diversification of supply chains. I don't think there was anything unanticipated or inappropriate about having a trade deficit with Vietnam. I find it very difficult to know what the Trump administration will be looking for or expecting.
Well, and of course, China's Xi Jinping himself was discussing trade with Vietnam today. On the subject of Xi and of the Chinese government, which of course you had many conversations with over your tenure as Treasury Secretary, you made tracks to Beijing yourself. Given your interactions with China and the way in which they have responded to the tariffs the administration has levied on Chinese imports, do you see them as willing to come to the table on this one, or are we stuck in a dangerous game of chicken?
Well, I think they've made clear that they would like to de-escalate this conflict and remove their own trade barriers, the retaliation they've announced, and see our trade barriers come down as well. I think they're tremendously damaging. They're at levels that are almost prohibitive of trade, and I think it would be beneficial for both sides. I will say in the case of China, and I've made this clear during my own visits there, we have legitimate grievances with some of the policies that China has followed to massively subsidized its export sector, its manufacturing sector, particularly advanced manufacturing, and its overall macroeconomic strategy, which places unusually low emphasis on consumer spending as a source of demand and really relies on flooding the world with Chinese goods. I think this is legitimately damaging to the U.S. economy and something that we were discussing, and I think there should be dialogue and an attempt by the Trump administration to pursue this issue. Working together with our allies, I think, would have been a desirable approach. It's one that we were committed to, but now the Trump administration has really engaged in some very antagonistic initiatives relative to our closest allies, and that looks like a less promising approach than I would have hoped.
Her take on the trade war is currently underway. Janet Yellen speaking exclusively here on Bloomberg TV and radio with Kayleigh Lines last evening. That was part of the late edition of Balance of Power. As we wake up to the story today, let's just stay right on this bead with regard to tariffs and specifically China, ordering that its airlines stop doing business with Boeing. No more deliveries of airplanes. Also, carriers halt all purchases of aircraft-related equipment and parts made by U.S. companies. Maybe this isn't a big surprise. You know the tariff story here. 125% on American goods. That's going to make it pretty difficult for anybody to afford airplane parts. But how many jets was Boeing selling to China? This is why we wanted to talk to George Ferguson, our expert on this, senior aerospace defense airline analyst at Bloomberg Intelligence. George, it's great to see you. I understand, based on our reporting and the story that I read on the terminal, that there were 10 jets, 10 737s preparing to enter Chinese airline fleets. But how much business was Boeing doing in China?
So the answer is not much since the pandemic and the first Trump administration. So this headline I really see as largely symbolic. Right now, China has about 240 some airplanes on order for Boeing. Boeing's narrow-body 737 backlog alone is 5,000 large. Before the pandemic, China would take 300 narrow-bodies, 737s or A320s per year when they were growing like 8% GDP growth. They're taking 150 per year last year. They were almost all Airbus. China's really stopped buying from Boeing for a while. I think we've kind of decoupled Boeing and China.
Yeah, never really recovered from COVID, I guess, to your point. But, you know, there is a message that's being sent here. Does it actually have a material difference in Boeing's business? Not just China, but regionally, the impact that this has on the image of Boeing? Or is this just kind of a wash?
No, I mean, I think Boeing, I'm sure, would love to sell airplanes into China. It's an important market. I think if they get growth moving again, it'd be even that much more important. And again, Airbus put 150 airplanes into that market last year. Would Boeing like to add 75, 80 airplane deliveries a year into China? That's almost 2 months of production for the 737. Yes, but like I said, since the first Trump administration, the Chinese really stepped back from orders, and after the crash of the MAX, really stepped back from orders, and really hasn't come back since then.
There were grand visions as we were coming out of the pandemic, as I'm sure you remember, George, about a trade deal potentially being struck between the Biden administration and China. It was going to unlock hundreds of airplane orders just at a time when Boeing was getting back on its feet. Was that ever real?
It never had an effect. No, the original Trump administration also, cut one of those trade deals that had numbers built in of a lot more purchases of Boeing airplanes. It never happened. So I know right now we're very focused on the current tariff environment, and I agree it's been a bit antagonistic, but there could potentially be a silver lining here for Boeing, that if we do get to a point where we make a deal, Boeing products could be on the table as being sold into China again, but we're probably a distance from that right now.
Interesting. We've got United Airlines earnings a little later today. George, we're going to be listening closely for commentary on what the tariffs mean. What we heard from Delta recently was meaningful. The idea that people are pulling back on vacation spending, that businesses are pulling back on biz travel. What will United tell us tonight?
So I guess they'll tell us as little as possible, similar to what Delta did. My sense from the Delta call really was, in the numbers, we didn't see a lot of change from the trajectory we were seeing at the end of last year in their numbers. And I think United, we're going to see the same in the numbers. We're seeing a bit of weakness in that basic economy traveler, especially domestic. They're the people whose pocketbook is most pressured. But I think what you're going to hear from United as well is that they're concerned about the higher end leisure traveler, right? Those are the people that respond to the wealth effect more. And look, Delta was at the height of that problem, right? The markets were really gyrating intensely at the time Delta reported earnings. There's a little less intensity. Some of that wealth effect has come back, but I think you're going to hear they're very concerned about that high-end leisure traveler holding up here.
Maybe United can get a discount on some of these Boeing jets that are not going to China.
They probably can.
I'm not sure about that. You tell me, George, but I do wonder, with this halt on Boeing deliveries, knowing how small this business already was in China, does this help in any way to sort of hasten the arrival of a domestic airline making industry, an airplane building industry in China?
I think it does help. I think in the Chinese plan is the COMAC C919 taking more of the fleets. And they've delivered, I think they have about 20-ish airplanes in fleets flying. The data we see on the airplane is they can't, it isn't as robust as Western jets yet, right? It's not always available to be flown, so they're not getting the same number of hours per day. There is a bit of a challenge here as well with a trade war with the U.S. in that airplane too, because it's powered by GE LEAP engines. And so as we get into this discussion of tariffs and technology, the Chinese aren't ready to make their own jet engine, and so they need to be cognizant of the fact that they're importing that from the U.S.
Wow. Fascinating insights, as always.
Sorry.
Yeah.
There's still a distance from building in size. They're still at a distance before they build in size, like Boeing and Airbus do.
Really great stuff. George, thank you. George Ferguson giving us the real take on this story that generates a lot of headlines, but there may not always be a lot behind it. Certainly the idea of Boeing in China leaves a lot to be desired for the airplane maker, and this might not change much in its business. We'll keep tabs on that for you. George Ferguson, thank you. We'll assemble our panel next. Rick and Jeannie are on the way in as Joe Biden makes his return to the national stage. It's on Bloomberg.
It's 12:40 on Wall Street. I'm Amy Morris. Bank of America posting a record quarter. That company reaping the benefits of volatile markets and net interest income topping analyst estimates. CEO Brian Moynihan spoke on this morning's earnings analyst call, forecasting no recession nor rate cuts this year.
Our research team, like many research teams led by Candace Browning, does not currently believe we'll see a recession in 2025. However, they've lowered their GDP growth rates for 2025 and continue to see no rate cuts during 25, but expect as inflation gets under control, you may see them in the future.
Revenue from equity trading rose 17% the first 3 months of this year, helping Bank of America beat analyst estimates for per-share earnings. Equities on the rise for a third straight session as bonds are stabilizing in part because of that strong bank data. We do check markets for you all day long here at Bloomberg. The S&P 500 is up 0.3%, NASDAQ up 0.4%, the Dow up 0.2%. The 10-year Treasury yield at 4.32%, the 2-year yield at 3.83%. Elliott Investment Management has built a large position worth over $1.5 billion in Hewlett-Packard Enterprise, planning to engage with the company to boost value. HPE's stock has fallen roughly 33% this year. Today, it has jumped more than 5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Balance of Power with Joe Matthew.
All right, Amy, thank you so much. Watching Wall Street for us. We'll be back with Amy Morris a short time from now to keep tabs on the markets as we talk politics in Washington. They are, of course, deeply connected here with what's coming out of the White House, impacting stocks and bonds on a daily basis. Wonder what Joe Biden will bring to the markets. Does the Biden speech move pharma stocks? I don't know. He's going to be back on the national stage for the first time since leaving the bubble today to talk about the issue of Social Security. I don't know if this is going to bring the kids in at last, but as he speaks to the National Conference of Advocates, Counselors, and Representatives for the Disabled in Chicago, Joe Biden will make a warning about the impact that this administration is having on Social Security, his concerns that President Trump's agenda is threatening the retirements of millions of people. Of course, Donald Trump blames Joe Biden for the very problem that he thinks he's trying to fix here. We've seen a couple of appearances, but nothing like this. This is a policy address, and you better believe they're going to be watching at the White House and responding likely on Truth Social. It's where we start our conversation with our political panel. Rick Davis and Jeannie Shanzano are with us. I miss them both. Bloomberg Politics contributors. Rick is partner at Stone Court Capital, and Jeannie is political science professor at Iona University. Great to see you both. This is your moment, Jeannie. Which Joe Biden shows up tonight?
I don't know which, but I know neither should Joe Matthew. This
really?
is, absolutely not. The reality is James Carville has been out telling Democrats to play possum. And then in his latest piece in the New York Times, he says, don't become the story. And then he pleads, please don't become the story and get in the way. And, even if Joe Biden is right on the message, the messenger is all wrong. He is going to give fodder to the Republicans, to Donald Trump, who was talking about him in the White House yesterday. He should work behind the scenes. These reports from NBC and others that he wants to get out front and help the Democrats. He can't help them now unless he does it behind the scenes. So message may be right. Messenger is totally wrong. He should stay home and talk quietly. Give advice quietly, Joe Biden. Not that he'll listen to me, but that's my advice. It's not a good idea.
Don't do the speech. Stay home and speak quietly. Rick, is this a gift to Donald Trump?
Jeannie, if Joe Biden had been listening to you all these last few years, he'd still be president of the United States. I'm sure of that. Wow. Look, Democrats have an identity crisis, right? I mean, they've got Bernie Sanders and AOC running around the country doing these, events, getting thousands, tens of thousands of people to come and show up, spewing out the liberal diatribe that got them into the minority in all these Congresses and in the White House. And at least Joe Biden showing up has some centrist appeal, assuming these days he's still a centrist. And so it's just all part of this, mashup called the Democratic Party that doesn't seem to have leadership. So, not surprising, he's been baited into getting out there and doing his thing. I applaud his integrity around trying to preserve and protect Social Security. Assume that's the topic of the speech, considering the forum. And it probably could use some protecting right now. I mean, it looks like DOGE is all about trying to trim the sails of Social Security Administration, and frankly, maybe this is an alert to Republicans and to the White House to maybe rethink their strategy around going after the third rail of American politics.
Yeah, how true. I haven't heard that line in a minute. Jeannie, there's another speech happening right around 5 p.m., same time Joe Biden's talking. It will be a Social Security Day of Action speech by the Democratic leader in the House, Hakeem Jeffries. He'll be speaking in Brooklyn. Is that the speech that should be national?
Yeah, I mean, Hakeem Jeffries, he should be making these speeches. He doesn't come with all the negatives that Joe Biden does right now and on the heels of a great loss for the Democrats. And, again, Joe Biden is right. We need to save Social Security. He's been saying it for a long time. To Rick's point, we need moderate messages out there. Hakeem Jeffries and others can deliver it. But this is a problem with the messenger. And what happens is when they have a messenger, nobody hears the message. They're so caught up on the messenger. And the message is right. You have an administration who's being led around by the wealthiest man in the world who keeps describing Social Security as a Ponzi scheme and describes it also as an entitlement. It's not an entitlement. It's something that we work hard for, and it's something that we pay into and then get back in our later years. Democrats could do so much with it, but they can't do it via Joe Biden. So Jeffries is better at making this message, and Joe Biden can help behind the scenes. But Democrats are going to have to come up with people who can deliver these messages. And unfortunately, one of the stars, governor of Michigan, went into the White House and hid her head behind a folder. So, we're having some issues with these kinds of appearances of late, but we'll get it together soon.
Jeannie's on today, Rick. I don't know if there is a Democrat in your book who could seize on a moment like this. If his name is Hakeem Jeffries or otherwise, it might be difficult for him to rise, through the headlines to actually get in front of people in Michael. Or is it another former president? Is it a Barack Obama?
Well, the trick is to find an emerging Democrat who could be the future, not the past, right? Joe Biden, Obama, Bill Clinton, Hillary Clinton, they all represent the party of the past. And they need to be on a new road because the party itself has changed dramatically since all of them held public office. And so who are they going to talk to? What constituency is out there for the Democrats? And have they figured that part out and who that then matches up to as a potential future candidate? At the end of the day, Carville's more right than wrong. This is kind of, it is probably more a congressional cycle than a leadership cycle for the Democratic Party, which will, sort of announce itself during the presidential primaries in 2027. And so, yeah, I mean, Hakeem Jeffries, loyal opposition, he's got to get out there and beat the drum and do what he can. It's a toothless claim, right? I mean, there's nothing he actually can do to disrupt the functions of the DOGE, the White House, the Republican Congress. But he can at least make the public policy argument, and it sounds like that's what he's going to do today.
Well, while we're talking about Social Security, Jeannie, it's just one of many agencies that's been targeted here by the DOGE. Another one is kind of in the crosshairs today because it's tax day, the IRS. Pretty important story here that hit the terminal since we took air right around noontime. About 20,000 IRS workers, 20%, are taking the Trump administration's second deferred resignation offer. They're basically taking buyouts. At the IRS, we were told, was already woefully underfunded, understaffed. You could cheat on your taxes all day long. They'll never find you. What does another 20,000 do to the IRS, Jeannie?
Yeah, it adds to a tax season nightmare that everybody has been talking about. And it makes literally no sense from a policy perspective. There is an absolutely right way to cut the size and scope of the government like any other organization. And then there's a really bad way to do it. And the sense by which they have made these cuts is very hard for anybody to untangle. After all, we're talking about one of our only agencies who actually makes money. And imagine if the IRS collects less money than expected this year, and we are up against this, this ceiling and the debt. It comes earlier than expected, and it blows a hole in the Republican and Donald Trump's abilities to get this bill through. It makes no sense, just like with the tariffs. The layout of all these things is frustrating. The execution is deplorable. So even if you agree we need to cut, which I do, the way they're doing it is maddening because you can't make any sense of it beyond just a wild cut of people and no thought as to what the repercussions and long-term impacts of that is.
It is hard to ignore the irony, Rick, of these Doge cuts at the IRS and kind of the decades-long attacks on the IRS by many Republicans may in fact hasten the X date to bump into the debt ceiling. Is that what we're going to be talking about in the middle of this summer?
It's hard to separate, sort of the public attitude toward filing, right? Do your job as a taxpayer, file on time, pay your taxes on time, adhere to the law. And then on top of that, sort of the Republican / Trump administration war on the IRS. And it's not, it's kind of a collision course between now and October, right? We're going to see what's filed today, but like the firings to date, 7,000 employees, maybe 5,000 additional left, in early retirement. Many of those are still working today and haven't actually gone off the job. How much will that actually affect the numbers coming out of today and therefore the impact on the debt ceiling? It should be marginal, right? I mean, like, are we getting too excited about the rhetoric and not realizing that there's plenty of people to actually get the work of tax filing done at the IRS today? But I do worry about the message we're sending to taxpayers. It's almost like, hey, cheat if you can. I mean, like you might not get caught because we have fewer people working. I mean, that's a really dangerous message because, whether you like it or not, I mean, tax filing is kind of a voluntary effort, right? Nobody goes out there and forces you to do it. You do it because, one, it's the law, and two, it supports your country. And you start taking those things away and creating a conflict there, like, oh, somehow filing your taxes isn't good for the country because the White House hates the IRS. I mean, we got to be careful with the messaging here. I get making cuts, and every agency is going to go through that, some in very dramatic fashion. But let's not, like, throw government so far under the bus that people actually decide, well, they don't deserve my money.
Yeah, right. There are no signs that this is happening yet, Jeannie, at least from what I'm reading on the terminal here through March. Gross U.S. budget receipts for the fiscal year were up 3% to $2.26 trillion, according to data from the Treasury Department. We spoke on Friday on Bloomberg with the Deputy Treasury Secretary, Michael Falkender, said, quote, "This seems to suggest we may have a robust tax filing season in terms of revenue," unquote. So are we going a little far with the rhetoric here, Jeannie?
We don't know yet, and let's hope that's the case, that it is a robust season, that these were smart cuts. But what we do know is the IRS's responsiveness is going to slow the further the season gets on. And so that is the real challenge here. We have early numbers which look hopeful. Let's hope that they hold up. And if that's the case, then maybe these cuts have been smart, but it's a heck of a way to start a tax season. And, when you have this many people who need help, try calling the IRS. It is just a nightmare. And that's just one example. And lack of service of that kind will impact people filing.
Well, it does seem that the IRS and Social Security, which we've spent the balance of our time talking about here, do have one thing in common. The phone is ringing off the hook Rick Davis, Jeannie Shanzano. Great panel, great conversation. They're, of course, going to be back in our second hour as we welcome our global television audience with more focus on taxes here and a conversation that we're going to bring to you. We'll have an update live from the White House from Tyler Kendall and a conversation with Erica York at the Tax Foundation. Might have some insights on this with breaking news this past hour from Bloomberg. Again, another 20,000 IRS workers are taking the buyout. That's 20% of the workforce that the agency began this year with. I'm Joe Matthew in Washington. Great to have you back here on Bloomberg Radio. Kaylee's on the way in for hour 2, so stay with us on the fastest show in politics. This is Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
The Tax Day edition. I'm Joe Matthew alongside Kaylee Lines in Washington. Yes, on this Tax Day in America, where we're trying to gauge the impact of DOGE cuts on the IRS. Kaylee, as well as the future of tariffs. We're trying to fill in the blanks on both, and maybe we'll learn a bit more today. We can tell you that some 20,000 IRS workers have decided to take the buyout, making some people wonder what that will mean for returns.
Yeah, if there's less people to process the paperwork, what exactly will that mean? Especially knowing that the receipts will factor in ultimately to the X date, when the U.S. government will no longer be able to meet its financial obligations, which factors in, of course, to the ongoing budget reconciliation conversation in Congress. They're assuming the X date right now is late summer, August, September time period. If that gets pulled forward, though, it's going to make that work a lot more urgent.
There'd be some irony if Doge cuts are, in fact, what hastened the X date, and that may be what they're dealing with. They're out of town, by the way, lawmakers, the next 2 weeks.
Lucky
it's going to
them.
be a minute. Yeah, lucky them. Before we find out what's going on, Donald Trump will be rounding out the first 100 days of his second term in that time. And we could learn potentially more about tariffs, but this investigation into chips and pharma is going to take a minute.
Yeah, the Section 232 investigation officially opened yesterday, although President Trump suggested he might have news on semiconductor tariffs in particular within this week.
We'll see
These
about that.
investigations usually last, 270 days? So perhaps they're talking about a truncated timeline.
I guess that's true. It's, of course, moving stocks all the while, and we'll be watching Wall Street for you here, including shares of Boeing, to see the president's accusing China of reneging on a deal to take some Boeing deliveries. They're not going to be doing any more business, it seems, and with a 125% tariff on plane parts, that may not be too much of a surprise.
Yep, the tip for trade war comes for Boeing as well. We'll have the latest on that this hour, of course, but let's get the latest on the markets, how they are reacting to all of this news, and check in with Amy Morris, who's here in Washington. Hey, Amy.
Hey, Kaylee, thanks so much. After green on the screen all morning, yeah, you're right. Markets are pairing gains now. S&P 500 is little changed. It's down 1 point. NASDAQ down 0.1%, and the Dow is down about 0.1%. The 10-year Treasury yield at 4.31% and the 2-year yield at 3.82%. Now, all of this started with a rally in Wall Street's biggest banks. That helped lift the stock markets this morning, but investors are reacting now to headlines on President Trump's tariffs war. The Canadian government saying that it will allow automakers to import a number of U.S.-made cars and trucks without tariffs as long as the companies keep manufacturing vehicles in Canada. And the government of Canada said it would provide a 6-month reprieve on imports from the U.S. used in Canadian manufacturing, processing, food and beverage packaging, and certain items related to public health. The U.S. economy is expected to lose billions of dollars in revenue just this year because of a decline in foreign tourism and boycotts of American products. Arrivals of non-citizens to the U.S. by plane dropped about 10% in March from a year earlier. International travelers spending a record $254 billion in the U.S. last year. The decline in foreign tourism is attributed to increased hostility at the border and rising geopolitical frictions. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's get back to Balance of Power with Joe Matthew and Kaylee Lines.
All right, Amy Morris, thank you so much. I am indeed Kaylee Lines alongside Joe Matthew, who is back in Washington. But yesterday, our focus here in Washington was actually on what was happening in Argentina, where the Treasury Secretary, Scott Bessent, was and sat down for an exclusive interview with our colleague, Anne-Marie Hordern. And a really interesting part of their conversation, Joe, was when he was talking about the ongoing negotiations and what he really thought the hardest part of them would be. He suggested tariffs might actually be the easy thing to address. It is what he described as the insidious non-tariff barriers that he said is the demon that needed to be exercised. And I wonder if that's what's factoring into our understanding. Bloomberg's reporting today that Europe is not really getting clarity on the administration's aims here, as non-tariff barriers with Europe when it comes to the value-added tax and regulation are things this administration has been griping about.
How true. Really something to find a story on the terminal as well, that with this lack of progress when it comes to the VAT or whatever it is we're talking about, the EU is essentially suggesting that these tariffs are going to be in place for some time, maybe indefinitely, preparing for the worst. That's where we start right now with Bloomberg's Tyler Kendall, who joins us live from the White House. Tyler?
Yeah, hey Joe, welcome back. Well, Bloomberg News reporting that the European Union, the U.S. have made very little progress when it comes to trade talks. The EU's trade chief was here in Washington just yesterday. We know that he met with the USTR Jamieson Greer, as well as the Commerce Secretary Howard Lutnick. And per people familiar with that meeting telling Bloomberg News, EU officials left with very little clarity on exactly what the U.S. needs to see in order for a deal to get done. We know that the EU had paused its planned retaliation, actually slated to go into effect this this week in concert with the White House's 90-day pause on that so-called reciprocal tariff plan. But the sense, per our sources, is that the EU is bracing for very little reprieve when it comes to the so-called reciprocal tariffs, as well as those sector-specific tariffs that are already in place, including on steel and aluminum, as well as autos. The European Union has put forward at least some proposals that we know of, including that both sides should drop their trade barriers when it comes to industrial goods, as well as pledging that the EU will boost its imports of U.S. LNG. But at this point, we haven't seen any indications that the U.S. is taking those proposals seriously, even though we do know that President Trump has previously signaled that he would like to see energy potentially rolled in to a deal with the EU. We know last week, according to Bloomberg News reporting, that the European Union was putting together a so-called term sheet with some things that they might be willing to concede in these negotiations that include those non-tariff barriers that you were talking about, like standards and regulations. It remains to be seen, though, if they would go as far to include the VAT or the digital services taxes that this White House often points to, because as Kaylee mentioned at the top there, Scott Bessent saying yesterday, tariffs aren't the difficult part of the negotiations. It's those non-tariff barriers that can prove more insidious, as he said.
Well, and I guess there's, at the very least, the idea that the EU's trade chief, Tyler, did get to sit down with the Commerce Secretary and USTR yesterday. Those conversations, at least, seem to be happening. I'm not sure the same can be said about conversations with China, as no one has yet to pick up the phone in Beijing, as far as we understand. And now President Trump's obviously upset with the latest from China, the halting of Boeing deliveries. He says on True Social today that they're reneging on a deal.
Right, just the latest tit for tat in what is an escalating trade war. Our statistics show us that China's forecasted to make up to 20% of global aircraft demand over the next 2 decades. So this really will have a significant impact in the marketplace going forward as we watch both of these sides escalate. Scott Bessent, in his interview yesterday, saying that the U.S.'s planned tariffs are not a joke, even though that's how it's been characterized by Beijing, with that now 145% total tariff in place. And when we're talking about who's not engaging, it's interesting to see who these countries are engaging with. This White House has repeatedly said that it is prioritizing those countries that are geographically close to China, like Japan, South Korea, Vietnam, India, these countries that Scott Bessent continues to reiterate that they are engaging with. But then, Joe and Kaylee, look at the other side. Xi Jinping currently on a Southeast Asia tour, visiting countries like Malaysia and Vietnam, as he tries to shore up his own support to counter this White House.
All right, Bloomberg's Tyler Kendall live at the White House for us on this Tuesday. Thank you so much. And of course, not just any Tuesday, it's also tax day in the U.S. And as we consider what kind of actual revenue raiser tariffs will be in terms of import taxes that are charged, we have to consider as well all of the other tax revenue that is or is not coming into the Treasury's coffers as we wait for clarity on what the receipts this tax season actually looks like.
The administration has been telling a pretty good story about that, pushing back on the idea that revenue will be lower. In fact, we're up 3% in the fiscal year through March, according to the latest. That doesn't tell us what's going to happen the rest of